Thank you, Bernice. I hope everybody else can hear me too.
Yes, we can hear you.
Okay, perfect, perfect. All right, guys, my name is Kanyisile Muleketi. I'm going to take you through the tutorial today. Yeah, hopefully it's going to be a very interactive session. I mean, you've been through a few Endonamo sessions by now. You know we like the talking, we like the questions. We prefer for you to stop us if you've got questions. If you raise your hand and I don't call on you, please jump in. Please unmute and talk, so that we can talk, so that we can engage, and so that I don't, if I'm going too fast or if I didn't spend enough time on a specific principle, please let me know because the reason I'm here is to help you. If I don't do that, then I might as well have not come. So please, 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 I beg you, don't be scared. If you've got a question, chances are someone else in the room has a very similar question. So please, 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 don't be shy. Let's engage. Let's debate. Let's have a great time. Um, yeah, so I guess to start off with, our question is on no more load shedding. First question I'll have for you guys is, have you had a chance to work through it? How did you find it? Did it make sense? Was it challenging? Let's discuss the areas that you thought were not so clear, perhaps, or need more, would like me to spend some time on, extra time on. Not all at once, please. No, no takers? Hmm.
Okay.
Oh, thank you. Thank you, Vital.
Yeah. For me, I struggled to to know to identify for A. I struggled to identify the error. So when I read that, I was like, everything is perfect. So I had to read it so a bit a bit more, and then yeah, that's when I think what I got is the error. I'm not sure, but yeah.
Okay. Yeah, no, I thought so too. When I first read, I was like, people are gonna struggle with this. They're gonna read and be like, how? You're not telling me what error was made. I don't know how to correct it. Tell me what's wrong.
Yeah.
But I think you start to see more and more of this in CTA as well as in ITC, where and even further, right? Once you get to APC level as well, where they just open it up to you to be like, okay, guys, here's the facts. You are going to now be expected to figure out, and I guess this is one of the skills we're going to practice today. As you're reading, to be like, okay, does this make sense in terms of, okay, first of all, which standard am I in? Which portion of the standard am I in? Does this make sense in terms of what I know? And that helps you identify the error even before you, even then you'll be able to preempt the question. You'll know that there's an error here. They're going to tell me that these people have done something wrong. You'll be able to see it before they say, something has gone wrong. But that comes with practice, right? We have to exercise that muscle and get used to engaging with the questions in that way. I see there's a comment in the chat from Tato. Yes, the effect of the increase in own credit risk. That's also fun, right? It's also something I don't know how often people see it. I don't know if have you guys actually ever seen it before in your studies? This dealing with own credit risk and financial liabilities.
Yes, I have seen it before. I was doing CTA last year, so but it always troubled me. So yeah.
Yeah, no. Look and listen. It dribbles some people already in practice, in actual work time. It dribbles us. So don't worry, you're not alone. But yeah, hopefully after this year, we'll have closed these gaps. Um, yeah. Oh, I didn't fully introduce myself, right? So I said I'm Kanyisile Mulegeti, take you through this tutorial. What I do on a day-to-day basis is IFRS. So I am an IFRS expert for one of the banks in South Africa. So I spend my life debating about IFRS, which is why please stop me if I'm going too fast because yeah, I debate about this a lot. So please, please, please don't let me run without you. Cool. All right. So any other comments on areas you found difficult, or even areas you found easy that you thought, oh, this is so obvious. Why would you ask me this? Okay, it's fine. I'm not gonna force you to carry on talking for now. So how are we gonna go through this, right? We'll work through the question. Okay, maybe let me take a step back. The lecture I just had with Rendani, that was much more focused, a lot, almost entirely, hopefully, on just the principles, right? Our focus now is, yes, we will discuss the principles as we go through the questions, the solutions, but we're also going to focus a lot more on the exam technique. Because sometimes even once you've got the technical in hand, the way you answer a question or the way you approach a question might be the reason you don't succeed in that particular question, even though you've got the knowledge. It's just the way it comes across. So we're trying to start from the very beginning to start enforcing, or should I say rather teaching the exam technique that we think is most useful. But of course, it always falls down to you. You practice once we've suggested ways to approach things, you practice and you see what works for you and what doesn't work for you and what slows you down, what doesn't slow you down. Cool. So we'll go through the question on a line by line, paragraph by paragraph basis to see what you were thinking, what additional stuff you could have been thinking. Then we'll discuss the principles. As we're going through a question, we'll discuss the principles which are tested. As we go through the required and the solution, which we'll do next is then speak to the good exam technique to apply as you approach each question. And of course, as we are going through each individual question, we'll speak to individual principles there. If I go too fast on any of the principles or any of the exams, any part, stop me, right? And say, that doesn't make sense to me, shouldn't we? And not even if I just go too fast, if you don't agree with something I'm saying, you're allowed to not agree. You're allowed to have a different view. Stop me, let's talk about it, and let's see where we land. Cool. So I will share my screen. So how I generally advise going through questions is first get an overview of what's going on, what's the industry, what are the different trigger points, what are the different questions that are coming about. And then, in this particular question, of course, they indicate, there's an error, they indicate, so what's happening with equity liability, get a feel of what's going on. Then, once you've understood this, go through the required and understand what they want from us. Then come back and as you're going through each question or each paragraph, you're then able to start to see how each paragraph could possibly play into helping you answer the question. So for now, I'm going to assume we've all read the entire question. We all have a feel of what's going on. So essentially the company we're looking at is normal load shedding, which manufactures, distributes, and maintains generators, right? Our particular area that we're looking at in this question is inventory. It is funding, essentially, because we obtain some bonds and then we have to classify those bonds appropriately and then measure them appropriately. Then we also have taxes, which is another very big portion of this question. I'm hoping, I know these topics can be quite challenging, but hopefully after this, they seem a bit easier and there's a bit of an idea of how to go about them. Cool. So done the first part of just kind of giving an overview what's going on in the transaction, in the overall question. Now we look at the actual required. And when we speak of exam technique, it starts to play in from the very beginning, from when you're now going and understanding the required, the way you engage with the required, that is also key, right? So you have to understand the keywords, the key trigger words, to make sure you're doing the right thing, to make sure you identify the exclusions, so things you don't have to do because it will just waste your time if you do them, which will take time away from things you should be doing. Ensuring that your response is complete based on the overall of what has been said, right? Ensure if there are different components to a specific required that you touch every single component. I think something to note just on this particular question is it is very much of an introductory, right, kind of questions, kind of a warm up into how CTA will be tested. By the time we are done with this year, by the time you're ready and sitting for ITC, the questions become a lot more integrated. So this question is very, yes, I think the question C, which speaks to the income tax, the tax expense note, that one starts to have some type of integration because it's to go back to something earlier on. But for the most part, our different requireds are split out. That won't always be the case within CTA. That's not the intention for us to carry on like that way. You'll also note in this question, as because information is split out so nicely, it's not too hard or it's not too cumbersome to try to sort through the different pieces of information. By the time we get to the end of this year, we want you to have been able to build the skill of being able to sort through different pieces of information, of being able to pull out key pieces. So this comes through critical reading and questioning as you're reading, and like pulling out very key information, plotting it out in a summary form for yourself, so that when you're coming to answer a question, it's easy to pull back from it. So I'm a big fan of timelines. Because there isn't too much information, I didn't do one, but maybe for yourself, start practicing and getting used to using timelines and seeing and seeing if you can use them efficiently, starting to practice using them efficiently. You could start to do that. But yeah, some of the key things you need to note is that this is not very integrated, and this will not be how things go on throughout the year, right? This is just let's warm you up. There'll also be other things I'll keep noting throughout to say, look, be careful of this. Although we might have 1 mark for this, in future it might be 2 or 3 marks. So there'll be all of those things as we go through. Okay, cool. Very long intro. So let's get straight into the required. So for part A. Part A focuses on information that is also A in the question. And what part A requires from us is to prepare the journal entries. So key to know what you need to do, right? That are required to correct the error. So if you at this point, this is probably you start to panic if you didn't realize it was an error, but we do know that there's an error, and we know which year, right? Very key always to pay attention to which year, because particularly in this instance, you'll realize that this error might have happened over 2 years, but they want to know how it looks in the FY 2024 financial statements. So key to keep that in mind, sorry. Then when it comes to the inclusions and exclusions, you're told to include deferred tax entries. So I would highlight in a different color to know a specific inclusion, so something that's been brought in, and you're told to exclude current tax. So I would highlight that in a red. So I remind myself to exclude, not to go there, right? So we know we're preparing journal entries on an error in which year, what needs to be part of it and what does not need to be part of it. These marks, you'll always see them, I think, sometimes around 20%, 10 to, well, not 10 to, yeah, about 10 to 10%, you'll see these in an exam question. Do not lose these. These are the easy marks. The communication skills, presentation layout, do not allow yourself to lose this. This is a very easy part of exam technique. So for example, here in part A, we're talking to journal entries. What does a complete journal entry look like? Because that's how you'll score the presentation mark. Typically, you would need a date. You'll see we don't have this, but I'll explain why. You need to have in the brackets explaining where each line is going. So is it a P&L effect? Is it a SFP effect, statement of financial position? Is it a statement of changes in equity effect? So for each line item, you need to note where it's going. You need to obviously have the amounts and you need to have the narration. That's how you ensure that you get your presentation marks on journals. Having said that, sometimes the question, and again, focus on exclusions, will specifically tell you, do not worry about journal narrations. In which case, you don't have to worry about them. You'll still get a presentation mark if you do everything else. If you get the date, you get the P&L, SFP, SCE correct. So be careful, be mindful of those exclusions. If the exclusions aren't there, ensure your journals have all the key components so you don't lose an easy presentation mark. Cool. Any questions on required A? Happiness? Then required B asks us to prepare extracts, so relevant extracts of the statement of financial position, P&L, and statement of cash flows. So a few key things here, right? Relevant extracts. So what we typically say when you've got a statement question or a presentation question is that get your structure right from the get-go, and still definitely get your structure right from the get-go. But you must be careful that you only bring in the relevant extracts, right? So what that means is you need to engage with a portion of the question that speaks to this and understand and figure out which particular portions of the statement are relevant, which lines under those sections are relevant, and bring those in as a structure to start off with. Don't bring in everything. So like you will see when you get to statement of cash flows. Statement of cash flows typically has operating, investing, financing activities. You don't need to bring in all three unless the activity is under all three. Otherwise, you're just wasting your time when you've been asked for relevant extracts, right? Then what do we need? Statement of financial position. So here it's, statement of financial position. So we are talking to, do we have assets, liabilities, equity? Which particular line items? Statement of P&L and OCI, which particular lines? And statement of cash flows, which particular class, categories, and which particular lines. Again, key, which year? The year ended 31 January 2024, and relating only to convertible notes. Sorry, convertible bonds. All right, another exclusion. Don't go and get carried away and start. Yes.
Sorry to stop you. There's a student who's asking if it's possible for you to zoom it for her. I think she can't see.
Okay.
Zoom your screen. Thank you so much.
Thank you. I hope that's better. Okay, let me know if it's still not clear. I hope it's fine now. Cool. So here, when we spoke in part A about the limitations, we need to look only at the convertible bonds, right? Don't get carried away and find yourself going through the entire question, putting things in from the previous question, so the part A, and bring in the inventory and the selling and distribution cost, and we're not looking for that, right? So be careful of the limitations of the convertible bonds. Other limitations, we don't need note disclosures. And you obviously can see, because we're talking about financial instruments here, IFRS 7 has a laundry list of disclosures. It would be a serious time waster if you are going to find yourself now trying to bring through all the disclosures related to financial liabilities. Okay, so no note disclosures and comparatives. Another thing about, and this is very important, for presentation, unless you're told not to include comparatives are required, because that's how statements look, right? When you've got a balance sheet, statement of financial of P&L and OCI, statement of cash flows, you always have 2 years. So unless you're told not to bring it in, you should bring it in. Cool. Then you're told not to do not classify separately between current and non-current. Again, key, don't waste your time. Communication skills, again, another communication mark here. Arguably, because this is a presentation question, there could, in other instances, be more marks for presentation. Alternatively, there could be some of the presentation marks that you get awarded, or some of the technical marks. So some of these 19 could get awarded for presentation. So we don't know where they sit, but I guess ours is not to wonder where the marks sit when we're doing another question. Is to ensure that our structure is right. Okay, so again, presentation questions ensure that you start off by knowing what you're working towards. You know what statement you need, you need statement of financial position. We'll talk about it and get to part B of what you should be thinking about. Okay, we need this, which line items will be affected. Statement of P&L, so write it up. Start statement of financial position, have those lines or assets, the line under equity and liabilities, which lines go under equity, which ones go under liabilities. Start to set that out. Same with the other two statements, and then go into the calculations. Otherwise, you find yourself, you run the risk performing calculations you don't need, right? So you win in two vibes there, because one, you are giving yourself time to plan, because you are setting out the statements and thinking through which lines you'll need, etc., etc. But two, you're also more likely to score presentation marks, and sometimes some of the, as I said, main marks in the question. Happiness, again, we'll go through all of this, and I'll show you practically when we're going through the solution. Then the last one requires that we prepare the tax expense note as it would appear in the statement, in the annual financial statements. Again, for FY 2024. In this question, it's not such a big deal, but you must always be careful of ensuring you're looking at the right entity, because sometimes we have a lot of stuff going on, something's happening in the group company, then there's maybe a sub somewhere there, and there's a JV, and there's different entities that you're being asked on in one test. So in this question, not such a big deal because we are only looking at NMLS. So, but for future, keep that in mind. Again, exclusions. Comparative figures, not required. Counting policy notes, not required. And then very key here, limited, because I mean, IS-12 also has a lot of disclosures, but you've got another limitation here. You only need to look at 79 and 18, which actually speaks to each other, right? Let me see if I've got it open. I do. So 79 basically says we need the major component of tax expense or income, which will be disclosed separately, and then 80 explains what that may include. We need current tax expense, any adjustments for current tax, deferred tax expense or income for reverse of temp differences, deferred tax expense or income for tax rates, unrecognized tax offs. So it's just essentially these. There's a laundry list. So we tend, and this is another risk, we tend to not spend too much time on the disclosure because we think, we'll just open the book and we'll just read what it requires. It needs to engage that so that you know that when they ask for this, you know where to get it, how to calculate it, and how to bring it forth. But anyway, the point I was making is it's a limitation of you only need the information required by those two paragraphs, not the rest of what IS-12 requires. Cool. Sorry. And they even tell you which method to use. So financial position method should be utilized to determine taxable income. Cool. Again, you'll note there's another communication skills, presentation, and layout. Fundamentally, your work should be easy to follow. That is probably the easiest way to score presentation marks. Workings, number them, so the marker can follow. So that will get you presentation marks, but also will limit the risk of people not being able to follow your work and then you losing marks for information that's actually on the page, right? So you'll see, obviously, we've got amounts we need to perform workings, which then feed into what goes into the note. So number those workings, similar to what we said in part B, that you're doing the text note, set up the structure before you get carried away, and then that'll drive your calculations. Cool. Happiness. Any questions? I am really hoping as we go, we're going to get more questions. The silence is not going to work out. All right. We learn more when we're engaging and challenging. Cool. So now we'll go into the actual question itself, and how I would like to approach it is to go paragraph by paragraph, pause for you guys to tell me what you think you're noting in there that could be relevant for questions A to C. Jump in, because I may or may not see hands being raised, so please jump in. And yeah, then we discuss what we think the correct thing was, or the incorrect thing is, or how we should be thinking about it, and then move on. Cool. And if you're not seeing anything, that's fine too. You can say, I don't think this one is all that relevant. So Jumping right in for the first paragraph, we are told that normal load shedding, LTD, in MLS is involved in manufacturing, distribution, maintenance of generators. Then incorporated 1999 by a former executive of ESCOM, and the financial year end is 31 January. Do we see anything that we think could be key in that paragraph?
I like the financial year end.
100%. 100%. Very, very key always. Anything else?
Wouldn't the industry also be important?
Yes, it is. You need to understand. And maybe let me ask you, from which perspective do you think the industry be important?
So if it's manufacturing, when it comes to cost of sales and inventory, the disclosures.
Perfection, right? So it's always good. Love that. Very good to understand what industry you're working in, because that affects what you expect for your inventory to look like. To your point, if you're in a manufacturing industry, we expect that at times we might, maybe not at year end, like in this case, but in most of those industries, we will have a breakdown of we will have work in progress. Oh, I like the work in progress at the end of the year. We purchase raw materials. The costs of inventory are different because of the industry we are in. If we're in a service business, for instance, we don't expect to see inventory. So very key to understand, right? So from a context point of view, to start to understand what we're working in, what you expect to see, and yeah. So yes, key to know what we're working with. Happiness. So we've got context. We know what the year end is. Next paragraph. We are told that during the most recent financial year, ended 31 January 2024, which is FY 2024, the company generated a preliminary profit before tax of that amount. This preliminary profit before tax was determined correctly after taking into account all transactions below, except for the error outlined in A below. What's key from there before we start unpacking A?
The profit before tax, because it's relevant for the tax note.
100%, 100%. And I would, in that case, also start making notes for myself, right? To just leave a comment. I mean, I don't know if you guys write electronically or if you write on, I don't know, on paper. So I'll just say text note, I'll say C. So that I note that when I need to come back to this, I know what this is for. I know why I highlighted a different color. I come back to it.
Yeah, and also the fact that it excludes A. I think it's also relevant.
Okay. Do I go further and explain why?
Because when the amount that we have to put in as our profit before tax in the income tax note has to include A as well. So yeah.
Exactly, right? Again, it's to make sure you have a full understanding of the information you're working with, to know that for C, A has been excluded from this amount of 9.9 million. So you may have to bring it back, or they may bring it back for you, but you know that this amount of 9.9 excludes what about read about in A. Going even further than that, it also tells you that there's an error in A below. So you already know before you start reading A that what they're about to tell you is wrong. You know that someone has done something wrong, and it's for you to identify what this wrong thing is. So you're going into, you don't get your mind into the mindset of questioning as you're reading to say, okay, does it make sense? Does it make sense? Does it make sense? So don't read just to consume at this point. Read to question, push back at what you're reading. See if it makes sense in the context of what you understand, what they're trying to do, what the accountant says they're doing. Is it consistent with your understanding of how IFRS should be applied? Cool. Anything else that you see that's key in this paragraph? Anyone?
I don't think there's anything else.
Okay. I think the reason why I say something significant is because I believe in timelines. So we noted over here in the first paragraph what our year end is, right? Now we know we're working 31 January 2024. So I would know if I'm plotting my timeline, one of the points needs to be 31 January 2024. We know FY 2024 is what we're looking at. We now know that that's probably the last point, maybe. I'll put it close to the end of my timeline, 31 January 2024, and then have space for to plot things that happen before that timeline, before that date. Cool. Then now we go into the era. So we are told that in FY 2023, we started purchasing, so we started a supply relationship for some of our components that we use to maintain generators with electronics. Electronics wanted to be a long-term supplier of ours, and then entered into an agreement where they reimburse 20% of our selling and distribution costs, which relate to their components. And this reimbursement is effected on an annual basis. Cool. Anything notable from that paragraph?
Yeah, the fact that they reimburse 20% of NMR's selling and distribution costs, I think it's relevant, and also it's on an annual basis.
Okay, happy. So let's push a bit on that. Yes, definitely, it's relevant that they're going to reimburse 10% of our selling and distribution costs. Where are we thinking? Where do we recognize selling and distribution costs? What are we thinking? Yes,
in our income statement.
As just
an expense.
An expense.
Yeah.
Yes, just normal operating expenses, or if you're doing the other type of what is it? If you're disclosing not by nature, sorry, I forgot the other one. It'll be a separate line, selling and distribution costs, for your type of expenses. Correct? So thinking, okay, this is a cost. And maybe it's too early to think about it yet, but you're thinking, okay, it's cool. We're going to buy components from electronics, and then they're going to reimburse our selling and distribution costs. And what are we thinking? What are these components going to be? What are we going to recognize these components as? Which standard are we in?
Wouldn't we think about inventory?
100%. So we know we've got certain components, spare parts or inventory that we're going to have. And then but you start to think, okay, what makes, okay, maybe let me stop there before I preempt what your thoughts were when you read this, right? So your initial gut feeling when you said when they said they're going to reimburse 20% of our costs, so we know we're in inventory. We also know we've got an expense here. Are we thinking that these two are related initially? When you first be like, so are we? What are we thinking? Are we thinking these two must net off against each other? Are we thinking that why are they reimbursing selling distribution cost? Are they linked to them? Where's our brain going?
I don't think selling and distribution costs form part of inventory because they are post the material that we're buying is completed. So I don't think you can net the two off because the other one is not necessarily capitalized on the assets or on the inventory.
Exactly. Right? Exactly. So my first feeling when I was reading, like, why are they reimbursing costs that are after we've received the inventory and then we're selling? I'm like, okay, interesting, but that's their business model, but it's fine. Right? So we're already starting to say, okay, so where are we thinking now? We're like, okay, we're in inventory. And we're in inventory, we're thinking about the cost of inventory. What amounts can we capitalize the cost of inventory? So it's obviously the initial cost of buying the item. If we're going to manufacture it, obviously there'd be overheads, etc., which is not the case here. There'd be transport costs to bring it to us, not to sell it to our customer. So that's a very key thing. Always remember which transport costs come into inventory. So we're in that mindset now. We're like, okay, we're in inventory. This is how we cost inventory, and we're identifying upfront that this 20% is a selling and distribution cost, the cost that comes after inventory is already completed. It's now when we are at this point, we've probably even already sold it. it can't affect our inventory cost, right? And that, yes, this reimbursement is happening on an annual basis. So they're doing this calculation probably once a year. Cool. Anything else before I move on to the second paragraph? The next paragraph. Okay, sounds like silence, sounds like happiness. So then we are now in our current financial. Oh, on my point of my timeline. So I would have then had, the last point of 31 January 2024. I would then have had 31 January 2023 and the time period before that. And in that period, I'd have made a note to say, start or relationship with who are they, electronics, and reimbursement begins. Just so I know, coming back, I have an easy thing to look at to remind me of the key facts at different periods. Cool. Then in FY 2024, we're told we purchased components of 16 million, and we're told we purchased components of 10 million last year. And this year we used approximately 60%. Last year we used about 75% during the financial year, and the balance was in closing inventory. We're then also told we incurred selling and distribution costs of 950 for the current year and of 700 for the prior year, right? We then went and, electronics then reimbursed these amounts per the agreement. So that would be this 20% that they said they were going to reimburse. Our accountant then accounted for the reimbursements as rebates and deducted them from the cost of the purchase of the components. The error is considered material, was only discovered in February 2024. So this is even after 31 January 2024, right? This is now when we're closing out the 31 January year financial statements. No entries have been processed to correct the error. SARS is indicated they're not going to open the prior year assessment for the tax expense. However, they'll accept the correction going forward. Cool. So this paragraph has a lot going on, right? There's a lot going on here. This is where they kind of say to you, okay, I think this is the point when you realize that they're not going to tell you what the mistake was, that you have to figure it out by yourself, because they just say, oh, well, errors content material. What do you think is wrong? Right. So back to you guys. What did you pick up? Key piece of information to pick up in this paragraph.
Okay, for me, can you hear me?
Yes, can you hear?
Oh, okay. So for me, what stood out is the total selling and distribution costs for the current year and the previous year. And then also the error that I noticed was the fact that the accountant accounted for the reimbursement as rebates and deducted from the cost of purchase. So I noted that as the error that was supposed to correct. And then another thing is the fact that SARS will not reopen the assessment, so it's going to affect Part C.
Happiness. Okay. 3 things you unpacked there. That's SARS. Okay, let's start with, you said you noticed selling distribution. Yes.
I just wasn't sure whether 60% and 75%, whether it's relevant or not, so I didn't do anything with that.
Okay, perfect. That's fine. Okay. So it started the first part. You said selling and distribution costs. You noted these. You noted these to say, what are you going to do with them? Or else when you noted them, why were you noting them?
So that I can multiply them by 20% and then calculate the amount that was reimbursed.
Exactly, it's 20%. Cool. All right. This we already said, you noted this as the error, so we already got the comment for that one. This you're saying, okay, I'm going to get information about what SARS is saying, so this will affect the tax note. Cool. Then you're also being told about how much inventory they've bought, or from this particular supplier at least, for this year as well as last year, what the usage was, etc., etc. This point, not yet sure what we're going to do with it, but what I would have done, again, plot on my timeline, I would have plotted these amounts, selling and distribution, so I know what was incurred in 2023, what was incurred in 2024. Inventory, what was incurred and used in 2023. Hey guys, can you still hear me?
Yeah, we can hear
Hey
you
guys,
now.
Yes.
Okay. Okay, perfect. Sorry, my internet disappeared for 2 seconds, but we're back. Cool. Yeah, so I was saying I would have plotted all this information on my timeline. Not 100% sure where I'm going to go with it as yet, but I have it as a summary so that when I do need it, I'm able to see everything that's happened in the last 2 years and use it appropriately. Cool. Cool. Anything else from anyone with regards to this paragraph? Okay. Yes. I heard someone say something. Okay. All right, that's fine. Move on to the next one. All right. So we're then told that none of the components purchased from electronics were in work in progress or finished products because they had no closing inventory of work in progress and finished products on hand. And we are told that the components are carried in accordance with first in, first out method. And the tax base of the components is equal to the carrying amount. What do we see? What are we thinking? Which standard are we? Well, what information here is important for any of the calcs we're going to do, or any of the questions we've seen?
Wouldn't it be the valuation of inventory in IS2?
Meaning?
Meaning that inventory is valued at, sorry, I'm just trying to just first in, first out method. And then the calculation of the inventory always throws me off. It's different when it's first in and when it's weighted average.
Yeah.
The worst for me, but yeah, I'm here to learn.
No, don't try. I think just for you next time we must throw in a question for weighted average because that's fun and games. So just for you, sometime we must throw in a question for weighted average to take us through that. But yes, very key, and you'll see how it plays in part C. I initially actually went in I had a blunt moment. I was like, something's not working out here, but then I realized it's because I ignored the statement. So very, very key. I mean, sometimes, but very rarely, people use last in, first out, but it's very rare. Typically, you're in, first out, weighted average cost method. Very key to understand. Right? So what we say on first in, first out method is that the inventory, we assume that the inventory we purchase first will be the inventory we sell first. So when we look at the closing inventory at any given year, it should be made up at least first off from the things we bought in the current year. Things we bought last year. So let me give an example. If last year, for instance, let me use this example. We bought inventory of 10 million and we're told we used 60% of it. Then this year we bought 16 million. Oh, sorry. Last year we bought 10 million, used 75% of it. This year we bought 16 million, used 60% of it. When we look at the closing inventory this year, we assume that for us to started to use any of the 16 million, we've used all of it, all of the 10 million, right? So we assume that we maybe opened with a balance of 2.5 million, so 25% of this 10 million. But before we started to use the 16 million, that 25% was finished. So if we've used 60% of the 16 million, then all that can be in closing inventory is the 40% of this. We can't have last year's 25%. So it's not that we used 75% last year. So we've got that opening balance, and you're bringing the 16 million, and what's left is 60% of the 16 million, and no, I mean 40% of 16 million. What's left? The only thing that's left is 40% of 16 million, because we finished this 25% before we started to use anything. So our closing inventory can only be 40% of the 16 million with the first in, first out method. If we started to use the new inventory, it's because we fully used up what came in first. I hope that makes sense. Cool. I'm not seeing any hands. Cool. Thumbs up. Thank you. Thank you. Cool. Okay. So yes, all of those very key to know that first in, first out, know which method we're using. Had this been weighted average, very different calculation. Probably very different information too. So we also know that, well, before I say anything, is there anything else that anybody else has pulled out from that particular paragraph?
They talk about the tax base, which in the back of my head, I'm thinking deferred tax calculation in the statement of financial position method. Sorry, I'm thinking from UNISA perspective.
You are 100% correct. Don't apologize. You are 100% correct. This comes into play again in part C, where they asked us to prepare that note and even specifically told us to use statement of financial position method. So you know you're going to have to have the carrying amount, tax base, they use that to determine the temporary difference, and then calculate the tax from that. So here we're thinking part C, SFP method. All right, so I would leave little notes for myself, but very scrap, right? Very quick note that don't take too much of your time to write, just so that you know you don't have to reread all these paragraphs, because that wastes time as well when you're trying to answer. Cool. Anything else?
Hello.
Yes.
Yes. From the error that I picked is that the error which the accountant made will affect our opening and closing balance of inventory, because the selling and distribution costs were deducted from our inventory cost.
Exactly. 100%.
So it means that our availability, yes.
100%, right? Because what we said the error was is that they went and deducted from inventory, and they shouldn't have a certain expense or a recoupment of an expense or recovery of cost. So 100% right, Tirani. We have an error last year and this year. Why? Because we started this relationship in FY 2023. Perfect. I'm trying to think where I would make that comment. Let me see. Error. So in my highlighting to say error, I can add to say opening and closing inventory. I mean, to be even quicker, I could just say OP and CB inventory. Okay. Comfortable. So are we happy that in part A, or from the information A, we understand the problem we have, right? We understand that we are getting selling and distribution costs, which we agreed should be OPEX, or recovery of OPEX. Yeah, because we are recovering selling and distribution costs from electronics. The accountant, however, seemed to have seen this as a rebate. They thought it actually decreases the cost of inventory, but we thought this through and realized selling and distribution costs aren't actually part of the cost of inventory. So that's where the error is. So we know them already just from reading this. We've kind of formed it in our minds that we should start to think about the journals we're going to have to pass, because we know the inventory balance is wrong. We know we need deferred tax that's related to that, because we're told we need it. As we just mentioned, that's going to affect the opening and the closing of the thingamajig of the inventory. Anything else I forgot to mention? Okay, So even that, we can even start to note that, right? If we want to say, okay, we know what the error is, we know which lines it's going to hit. So we said opening and closing inventory. We know there's DT, or there's selling and distribution costs. So that we kind of, when it's time to put in the journals, we have a plan. We have a plan. We know how to go about it. Cool. Happiness. Questions? Any additional comments on Part A? Thank you, Katato.
I just have a question, ma'am.
Yes, go for it, Sandy.
I always get confused with SARS will reopen, SARS will not reopen, and so probably when we get to the later parts when we're discussing the solutions, you could just let it sink in my brain what it means, because I always get it wrong.
Okay. All right,
Thank
perfect. I will try. I will try to help you with that one. Cool. Any other questions? Happiness. Cool. So again, paragraph by paragraph, right? So for B, they tell us that we need a new fleet of delivery vehicles, and we are going to reduce our greenhouse emission footprint, which is very topical at the moment, but we clearly don't have the cash to fund this, right? So what we've done is we've offered 10,009% convertible bonds with a par value of 1,000 Rand each for subscription by the market. The bonds were fully subscribed, and we received all our cash on 31 July 2023. Each bond is mandatorily convertible into 3 ordinary NMLS shares on 31 July 2028. We are required to make coupon payments on a 6-month basis in arrears, first payment being on 31 January 2024, and this payment was made on time. Pause there. Another mouthful. What are the key things to pick up from there?
It's probably a financial instrument.
100%. So we're just like, okay, we've got a convertible bond, financial instrument, and which portion of the financial instrument are you thinking about? Which side? So you know we've got
liability.
Okay. Okay, so we know we're in financial instrument side. Okay. Is there anything that is indicated that might not be financial liability, it might actually be equity?
Yes, the number of shares, the conversion to say it's going to be converted into 3 ordinary shares, which might be fixed and not variable.
Okay, so we know we've got a classification issue here. We're in IS 32, and we even know which portions. We understand the definitions of financial liability and equity classification, right? And we already started with that, right? Because we're saying now, we know the bonds are convertible. So, okay, step back. We are trying to get funding. So people are giving us money, which we're going to have to pay back. So we know we're in financial instruments, but in the credit side, we don't have an asset, it's someone else's asset. We either have liability or equity, or both. All right. So we then need to think through the definitions of financial liability, the definitions of equity instruments, the definition of compound instruments. Cool. So we had said here, you said the equity comes through when we think about mandatorily convertible into 3 ordinary shares. So okay. Anything else that you guys think is relevant to note? No? No dates, no amounts that you think are actually going to come in handy in preparing our statements?
I think the dates are also important personally, because it actually helps us to identify if it's like what we've learned previously in the first session, our mandatory, like if the cash test, if we're going to pay or not, to make it to get to if it's a financial liability, to actually help in the discussion and us identify our class. What you call? Sorry, I'm mumbling. Classifying
No.
if it's really a financial liability.
Okay, unpack that for me a bit further. Are you saying that if we've got mandatory dates of payment, what does that indicate?
Like when I say mandatory, I already say that they didn't give an option, number one, like as if it's a compound. First, when I saw convertible, it's like, aha, maybe it's a compound. But when I read further, it's like, no, is mandatory, so therefore it's a financial liability. So there was no option given. So now if I have to break it down to give application, now I need to think of what is that word? The test that they taught us on our first session, if there's an obligation to pay out something, and also the
Unconditional
date.
rights to avoid repayment.
Yes, and also the date of it when it has to be paid.
100%, right? Many things you just touched on there. So yes, we already touched on that. You have to figure out this classification, right? So convertible, always a great indicator that it could be of a compound instrument. Then mandatorily indicates we don't have a choice. Then though, the key here is we're going to 3 ordinary shares. We're mandatorily convertible into 3 ordinary shares. So then this is when you take the step back to actually do the application to say, look, what is the definition of financial liability? What's the definition of an equity instrument? If we are going to settle something with our own shares, what do we consider? We have to consider if it's a financial liability or an equity instrument. And in this case, or in any case really, if you're going to settle something in your own shares, you consider what we call the fixed for fixed test. If you're paying a fixed number of shares for a fixed amount, then we are in equity. And if it's a non-derivative, we're going to classify it as equity. If we're going to settle by giving a variable number of shares, then we are in the realm of a liability, or financial liability. And how I remember that, or how it makes sense to me, is to say, if like today we are getting, someone is giving us, for example, 1,000 rand, right? And we are promising them, or we are stuck or obligated to provide 3 shares in 5 years' time in 2028. What that's saying to me is that that person is taking on the risk of the performance of the entity, right? Because they're going to get 3 shares. Whether my company value grows or decreases, those shares could be worth a lot more than what I actually owe them in 5 years, or a lot less. So they're taking on equity risk. Whereas if this was phased differently, to say the convertible into shares that amount to the value on that day, for instance, they're convertible into as many number of shares as amount to the 1,000 rand in 5 years' time, then we're actually, we are as a company have an obligation. We are taking on the equity risk, so it stays our equity. They don't have any equity risk. They know what they're getting. They're getting 1,000 rand. The 1,000 rand just happen to be in shares, but they can easily sell that. So because they know they're getting 1,000 rand, that's our liability. If they don't know, they're getting shares which could be with any value, they're taking on equity risk, so that's equity classification for us. Right? Does that make sense? Does that help?
Would you please repeat that?
Okay. So when we look at the definitions of a financial liability and equity instrument, part of it speaks to what do we consider when we're settling in our own shares. So if on 31 July 2028, so in 5 years' time, we're gonna settle this liability of the bonds by issuing shares, as is the case right now. The consideration is whether we are gonna issue a fixed number of shares or variable number of shares. So in this case, we're issuing a fixed number of shares. So the test is if it's a fixed for fixed settlement, so fixed number of shares for a fixed amount of cash, so 3 shares for 1,000 rand in 5 years, we would classify it as an equity instrument. The way I see it is the other party is taking on the risk, right? They are taking on the risk of whether the value of our shares, our company does well or performs poorly. They're taking on that risk. So they're essentially buying into the entity, right? They're becoming an equity holder because they're exposed to the performance of the company. Whether we do well, we do poorly, that's going to affect how much they get paid in the end. So that's how I see it as an equity instrument. On the flip side, if we are committing to saying, okay, in 5 years' time, we are going to give you as many of our shares as equal the 1,000 rand that we owe you in 5 years, we've got a liability because we are committed to making sure the counterparty gets 1,000 rand. We have a liability because it's on us to give them 1,000 rand, so the equity risk still sits with us. Did that help a little bit?
Perfect, makes sense. Thank you.
Thank you. Are we all happy? Okay. I guess so. With this part, what we're saying is because the bond is convertible to 3 ordinary shares, this would then be, this would be equity classification. But remember, we've got different payments, right? When you've got a bond, we have the coupon payments, which you have to make, and you have the principal, which you have to settle in 5 years. So, and this is where we start to think of compound instruments, because we could have a portion, which is a liability, and a portion, which is equity. So what we know is we're settling the principal by giving 3 shares. So the amount in 5 years, we're going to settle 3 shares, right? So that will be equity classification. However, we have not started to unpack yet the coupon payments. Does anybody want to have a view on whether the coupon payments would be a liability or an equity instrument? Does anyone want to ask a question? I'm going to maybe even take a step further back and explain what I mean by compound instruments. Am I just assuming we all know what we're talking about?
Sorry, may you please repeat the question?
Okay, the question was, with the bonds, we've got 2 different types of payments. We've got coupon payments, being the 9% that we're going to pay every 6 months. Then we've got the principal amount, which is the 1,000 rand, which we're going to convert into ordinary shares. So we've just spoken about the classification of the principal. As the principal is settled by issuing 3 ordinary shares, that'll be classified as equity. But we have not considered yet whether the coupon payments are also equity, or those are actually a liability, a financial liability, and therefore result in us having a compound instrument. Any thoughts on whether the coupon is liability or equity?
I would say coupon payments are actually liability, because if we're going to be going through the test that we did earlier on about avoidance and whatnot, so it is unavoidable for this NMLS to pay back not to pay the coupon payments, and there's also like a fixed or determinable date of like biannually. So I think it's a financial liability.
100% agreed, Amogela. And I think maybe I must make sure we all land on this one, because a very key portion of that definition of a financial liability is an unconditional right to avoid repayment of cash. It's a cash or another financial asset. Because remember, financial liability settles through cash or another financial asset. So that's always, and I think that's where this could be tricky here with the shares, because we're saying mandatorily convertible. So we know it's unavoidable, but we aren't settling in cash or another financial asset. So that's why that and the fact that it's a different product definition and it's actually fixed for fixed, that's how we end up with equity. Very different for the coupon payments, because we are making these every 6 months in cash. We are making cash payments of 9% of the par value every 6 months. And we do not have an unconditional right to avoid repayment in cash. So agreed, we have a financial liability for the coupon payment, which then means we are looking at a compound instrument where the principal is an equity instrument, and so the principal is equity component and the coupon payments are a financial liability component. Are we comfortable? Thank you, Tirani. Okay, thank you, Bernice. Please let me know if I'm losing you guys. Please don't ever feel bad for me to take a step back and just make it clearer, or try to use a different example. because even in practice, this stuff comes up. Thanks, Sandy. This stuff comes up a lot. Like when I first started within IFRS consulting, I spent so much of my time doing equity liability classifications because it's something that's difficult even for us in practice. So people don't always get it. So it's really key you get it in CTA. It's probably going to be tested a few times throughout this year, right? It's very key to land this. And I think like how I always fall back to, do we have an unconditional right to avoid repayment? If we do not, we're probably in equity. So that's very key. And then obviously the fixed for fixed and the variable number of shares, very, very key. Cool. So from a component point of view, from a classification point of view, we now know we've got both equity and financial liabilities. Does anyone want to venture as to how we initially measure these? So once we've got a compound instrument, what do we determine first? And how would we go about measuring this? Because we need to put this into our financial statements. No one? Really?
May I try?
Yes, please.
You said, okay, wait, sorry. You said how to calculate it, right? First of all, our aim is to get our liability part of it. In order for that, we can use our, are we allowed to call this a time value of money, the TVM method?
You can, so I would say we're getting the present value.
Yes, to get a present value. Yes, okay, yes, that, and through that we'll be able to get our equity out of it too.
Okay, unpack. I agree. I fully agree with what you're saying. Yes.
Can somebody else please unpack?
Someone said something just now. I just didn't see who it was. No one. Okay, I'll unpack then.
Okay, can I try?
Yes, Katato, please try.
Thank you.
Okay, so the first thing is we have to determine the fair value of the bonds, and then we have to determine the financial liability component of the instrument by using the interest rate on similar bonds without a conversion feature. And then after that, we subtract the liability component from the fair value to get the equity component.
Okay. So unpacked, Bernice, basically what you spoke to, we need the fair value. Yes, I see a hand up. No, Sipo, go for it. No, Sipo? If you're speaking, you're on mute. Okay, no, Sipo, I don't know if you've got maybe a problem with your mic. Okay. Let me know if you just jump in if your mic starts cooperating, and then we can carry on.
May I please ask?
Yes.
You said I was first trying to get the fair value. That's our first step, right?
Yes, and yes.
So, because I'm seeing there it's per value of 1,000 each for subscription per market. 100%. So I know that I am in a mini brain block, but can I please ask how much how many do we have of that? Because I'm trying to look for it, or maybe I'm not seeing it.
It's here. It's the 10,000.
The 10,000. Yeah. So that it can be a fair value. So that means now we can, through that, we're allowed to get our present value.
So a few things. Yes, you're right. We need to look at how many bonds we have. What's the value of those? How much are they subscribing, right? So we know we've got 10,000, 1,000 rand each. Then I do think it tells us later on, but we then need to consider, as you know, sometimes they'll tell you that they were subscribed at a discount. So maybe the par value is 1,000 rand, but subscribed at 950. So we know they didn't subscribe at fair value. Other times we know that the par is 1,000 and they subscribe it at that 1,000. So we know the fair value is the 10,000 times 1,000. So to get to the fair value, you consider whether we're buying at a discount or selling, or if they're subscribing for them at a discount or at a premium, or we're going to set at a premium, or any of those funny things. But in this case, they didn't mention of that. So yes, you're correct, Bernice, would have the 10,000 times 1,000 rand, and that would give us our fair value of the bonds.
Thank you very much.
Cool. So very important thing many very important things mentioned just now, right? First, we need to determine fair value. Why? Because financial liabilities, financial instruments, just generally, are initially measured at fair value, right? So we get the fair value, which is the 10,000 times 1,000. Then, as Katato and Bernice both said, we determine the financial liability component. And how do we do that? We perform a PV calc, and we'll get into different inputs just now. And then once we've got the value of the liability, whatever's remaining, we take the 10,000, which is our fair value of the overall instrument, we deduct the liability, and what's left is the equity, because equity is always residual, right? Equity is your rights to the residual in the company. So you start with the 10,000, do the calcs to get to the liability, and then whatever's left from the 10,000 is your equity. Comfortable?
I missed that a bit. Are we saying that if it's not mentioned whether they issued a discount or it's a premium, then we're assuming that it's it's at fair value?
Yes. So they would have to tell you, if they don't specifically say discount or premium, they'll say something which tells you that this is not the right value, or they'll say it's not at market value, or they'll say something about them they're being related parties and not trading at arm's length. But there will be something to tell you that something's off.
Okay.
Cool. All right. Unpack that quite a bit. Then, yeah, so you guys noted all the key things about the number of bonds. So we're gonna need all of this information, right? When we're doing our PV calc, we're going to need to know the starting amount. We're going to need to know the calculating at 9%. We're going to need to know which date we're starting on, right? Going to need to know which date we need to settle in, so we know the number of periods. I should probably have done all these in the different colors, right? And then we know that we're making the payments every 6 months. So those are going to be very key for our PV calc. Also, think about part B. What do we need? We're doing the different statements. One of the statements has to do with cash flows. So we need to know on which date different cash moved. We know we received cash on 31 July. We know we paid out cash on the coupon on 31 January 2024. And we made this on time. This is very key because if, for instance, the payment date of this for the coupon is 31 January 2024, but we only make the payment 7 days later, so in February, that's after our year end. And this is why I like timelines, so if we can make sure what is within the parameter of the financial year we're working with. So if this had been different and this payment had been made in February, we would not have a coupon payment going out in our statement of cash flows because the cash has not actually left us yet. Any questions, comments? Okay, cool. So yeah, I would use all of the stuff to put on my pretty timeline, so I'm aware of what's happening in which financial period. Then we are told that NMLS manages any liabilities that may arise from the bonds at fair value and accordingly classifies the liability at fair value with changes recognized in P&L. What's the significance of this single statement? It's very, very key.
The fair value gain and losses.
On
when the adjustment on the liability, yes.
Yes. But I'm gonna need more words. What do you mean? What about the fair value gains and losses?
As a caring person might give it to somebody else again.
I love how you're always launching everyone else. Anyone else? Know what? Okay, let's think about it. Let's take a step back. Bernice was right, of course. What we're being told is that our liabilities are going to be measured at fair value. What do we know about classification, right? IFRS 9 speaks to how we classify financial assets and how we classify financial liabilities. We know we're looking at a financial liability, and they're now telling us we're classified at fair value. What do we know about liabilities which are classified at fair value? Something key, something someone mentioned, I think earlier. About something tricky about these.
You don't reclassify it.
Again, not enough words, but yes. So financial liabilities, generally, most financial liabilities are measured at amortized cost. There are specific exceptions, such as derivatives and other stuff, but most financial liabilities are measured at amortized cost. This statement is telling us that we are going to, yes.
I think it's telling us that we would have fair value adjustment yearly, subsequently.
Yes, definitely, because we're measuring at fair value. It's also telling us that we've designated. Oh, sorry, I see a hand, Samsung.
Hi, ma'am. A quick question. I just heard you mentioning that financial liabilities are always measured at amortized cost. So my question is, because I think I once heard that we sometimes do reclassify them. When and how do we reclassify like financial liabilities?
Okay. So before I jump into that one, Samsung, first, not all financial liabilities at amortized cost, but mostly. Most financial liabilities at amortized cost. Default position for financial liabilities is amortized cost. There's specific exceptions, like I said, like derivatives will always be at fair value through P&L. Contingent consideration in business combinations. I don't know if you guys have done that, but you probably have by now. That'll be at fair value. There are other exceptions in IFRS 9. I don't want to go into it, but there are other exceptions. This particular liability doesn't meet any of those exceptions. So for them, what they're telling us is that they're designating this liability at fair value through P&L, and that designation is irrevocable. So they made that decision on day one that they're going to put it into fair value through P&L, and they're going to measure it in that basis. They can't change their mind. So this one they cannot reclassify. They've got no option to reclassify out of fair value through P&L. Right?
Makes sense. Thank you, ma'am.
Cool. And yes, even for the designation, you can't just designate items at fair value through P&L. For financial liability, you designate it as such if either there's an accounting mismatch. So maybe there's this liability is very closely linked to another asset that you've got, and this asset is classified at fair value through P&L. It's not going to make sense for your financial records because you're going to have fair value gains on this side, you're going to have interest income on the side. It's constantly just going to be strange. So there's going to be an accounting mismatch. Then you can designate the financial liability at fair value through P&L. Alternatively, what they're speaking to here is the second exception, where we manage the liability at fair value through P&L. That's the other exception that allows us to designate at fair value through P&L. Cool. So that's classification. One thing that is very key, though, is for financial liabilities at fair value through P&L, there is a portion that goes to OCI, and that relates to own credit risk. So that's the fun and games that we were speaking about earlier on. So, and the reason for that is obviously we don't. If your credit risk was to increase, other people's assets, if they're measured at fair value, essentially, would decrease, meaning your liability would decrease. But that doesn't make sense. Your liability is decreasing because you are now a higher risk. So that's why they stripped that out of P&L, and you show that portion in OCI, so that the investors and other users of the financial statements can understand that yes, the liabilities, we're correct, this is the value of the liability. But this portion, this credit we've got here, it's not because something amazing has happened, it's because I've become a higher risk. Does that make sense?
I don't ask the questions like that.
Okay, Enga, I saw you unmuted. Okay, I see there's a hand as well. Samantha?
Hello. Hello.
Yes. Go for it.
I wanted to ask, so for financial liabilities, also even financial assets, the ones that don't have that irrevocable election for P&L or OCI, if it's at amortized, then can you change to P&L or OCI?
Yes, but it's very, very, well, it's a very high barrier. So for financial assets, you will only ever change your classification if the business model changes. So remember, for classification of financial assets, it's based on the business model under which the assets are managed, as well as the cash flow characteristics. So if you do your assessment to realize it's a business model to collect contractual cash flows and you meet the SPPI criteria, so this financial asset is initial amortized cost, you can only ever move it to fair value through P&L if you've now changed the business model under which you hold it. Meaning, you initially held this asset with other assets where you were holding it to collect contractual cash flows, but something's happened in the business, something's changed. You have now decided you're moving it, and you're now going to put it into a different portfolio. And this portfolio, for instance, is managed on a fair value basis. So maybe the staff in that particular company or that particular division, their bonuses are based on on the fair value fluctuations of the financial assets. So now we're managing them on a fair value basis. The business model has changed. Then we can move it out of amortized cost into fair value through P&L. But again, that's a very high burden. You have to jump a few hoops for people to. You have to be able to demonstrate that the fair value, the business model has actually changed. But I think in a test they would tell you. I think they would tell you if the business model has changed. Then for financial liabilities, you've caught me on the spot now because I can't remember, but it's fine. We have the standards, and they will remind us when we reclassify. Okay, and then for financial liabilities, we do not.
Okay.
We do not reclassify any of them.
Okay, thank you.
Comfortable? Any other questions? Happiness. Okay, so I mean, Nkatebe? Who is Nkatebe? What's your name? Okay. Please mute if you're not gonna ask a question. Okay. Then we're given the annual nominal market-related interest rates on similar bonds. And this will help us when we're doing our PV calcs, right? So we know what it was on 31 July, which is the date the bonds were issued. So again, how I would my timeline would have had all of these dates to say on 31 July we issued the bonds, 31 January we made payments. This was the interest rate at this date. This was interest rate at that date. Cool. Then we're told that our cash flow problems resulted in an increase in our credit risk. And the interest rate increase includes a portion attributable to our own credit risk of 0.42%. And Khatari, please mute. And so this is a portion that's going to go to OCI. So these are considerations we should be having throughout, right? So we know that this will be the OCI component. I'd make a note for myself to remember. Cool. And then I don't know why my question looks so weird. There we go. So that is essentially B of the question, right? We're done. And Khatari, please mute. So we've basically dealt with the convertible bond in its entirety. What we must now think about is, okay, we were told we need 3 statements. Statement of P&L, statement of financial position, and statement of cash flows. Which particular lines do we think we need on statement of financial position? Or which do we think we've got assets? Do we think we've got equity and liabilities? Which lines are going to be affected? Anyone? Anyone, guys? I mean, there's so many lines. You don't have to give me all of them. You can just give me one.
On the bonds, since we're going to be paying interest, we're going to have interest on our statement of profits and loss and other comprehensive income.
Perfect. Agreed. What else do we have on the statement of P&L? Anyone?
I was thinking cash flow now. My brain has jumped to cash flow because of the payment that was made in January. So that's an outflow in my statement of cash flow. Easy marks.
Okay.
Easy marks.
Easy marks.
So are we gonna have a?
Yes. Yes, go Khatata.
So are we gonna have a fair value adjustment on the credit the company's credit risk?
We are, but yes.
Which will go to OCI. The adjustment will go to OCI.
100%, 100%.
Yes.
So which statement are we on there? That's the P&L. Okay. So loving the thinking everywhere, right? What we do need to be very guarded on is the structure, right? So definitely I would make all those notes that you're talking about. So Sandy, I would make the note to say, oh, okay, on this date, cash outflow. So I know I've got an SOFCF outflow. I would then challenge to say, okay, which class? What is this? Is it a financing, operating, investing activity?
Wouldn't it be operating because it's an interest expense? It goes at the top. Sorry, I'm looking at the financials at the cash flow in my head.
Perfect. Okay. Yes. So agreed. The thing about interest is companies have a choice, right? Unless you're a bank, with a bank are always in operating activities, but companies, other companies can choose, but it must be consistent. You could have your interest as an operating cash flow because it's interest income is how you operate, or you could have as a financing, as interest payments as a financing cash flow, interest receipt as an investing cash flow. You get to choose, but you just have to be consistent year on year. So let's say we're going to go operating. We can go either. Right? So as I'm saying, I'd make all these notes. I'd make all these notes to know what I need to do. I already made the OCI notes on the own credit risk. The other thing on P&L, we said there's interest, right? So we mustn't forget that, but I think that's more on these rates here. We don't forget that there's a finance cost or an interest expense that we need on P&L, interest. We're forgetting one key thing on P&L though, right? We said we've got an adjustment for own credit risk, which is going to OCI, but not all the fair value is based on our own credit risk. There is some portion is just normal fair value. Where are we taking that? How do we measure normal fair value items? Where do the gains and losses go?
If it's a gain, it go to the profit, and if you get a loss.
Exactly. So just normal fair value gain on P&L. Gain or loss, depending. We haven't done the calc yet. So just a normal, another thing on P&L, SV gain or loss. Okay, so so what I was saying is I would make all these notes, but once it's now time to actually answer, we need to have a structure, right? We need to, and this is why I'm writing the statement's gonna go to, so that I know when it's now time to put it into a statement, I know which statement, and I've got thinking in my head of, okay, this and this and this is going to financial positions, is going to P&L, is going to statement of cash flows, and I can put my structure together and do the calculations informed by that structure. Cool. So we've got our P&L. We've forgotten one thing on the SOs, on the cash flows, because yes, we've got the outflow of the interest. And Danny, go for it.
Oh, I just wanted to add on the cash flow that there's proceeds from the issuing of bonds.
100%. And where we classifying those? What type of cash flows are those?
Nice, please assist.
Huh? Going to the floor, guys. What type of cash flows are these? Are these financing, operating, investing? When we receive the money for the bonds.
It's financing.
That financing.
100% financing activity. Okay, financing. And we know which is a inflow. Okay. Right. Perfect. So, I mean, quickly on the principles there, we have 3 categories, right? Statement of cash flows, operating activities, investing activities, financing activities. Financing activities is really mainly your cash flows that are funding you. So when you get money in as a loan, as someone subscribing for shares, as what's I thinking? As paying back the people who've given you the bonds, paying back the loans. There's the capital repayments. Capital repayments of any loans and bonds would always be financing activities. Interest payments is the one that could be financing or operating. So really mainly your funding. Investing cash flows, those are very, very, well, the way I remember it is investing cash flows have to do with an asset. So it's when you're recognizing a new asset. So when you're buying, when you pay money to buy PPE, when you receive money because you've sold your PPE. So it has to do with a new asset or recognizing an asset. When you buy a new subsidiary, when you sell a subsidiary. Yeah, so cash flows has to do with assets. Those are your investing cash flows. Then your operating cash flows are tied to your main operations of the entity. Right, so your main business activities, your, what do they call them? The main revenue generating activities. So here, we would obviously, any inventory would sell, debtors, payables, so day-to-day operations. And that's where the interest, as I said, optional. Interest can be operating, but the interest income can be operating or investing, just consistent. Once you choose it, you stick to it. As long as it's consistent. For similar types of interest, you must go to the same place. If it's an interest expense, well, interest payment, let me not say expense. Interest payment could be an operating or a financing because it's linked to funding, so it could be financing, but it's also interest is it's a normal day-to-day kind of expense, so that the interest payment could be operating. The interest inflow could be an operating, again, because normal interest, or it could be investing because it's money you're receiving on a financial asset you have. Cool. Very, very quick reminder of the 3 categories. Are we all comfortable? Any questions? Cool. Thanks, guys. Happiness. Okay. One statement you haven't mentioned at all, guys. Statement of financial position. And there are a number of items that are going to go there. What are we saying? I mean, what do we have? They've got assets, they've got equity, you've got liabilities. All of those have to hit your statement of financial position. Give me one.
I'd say the current portion and the long-term portion of financial liability.
Agreed. The right liability somewhere. Okay. Yes. And just remember, yes, Sandy.
Our inventory will also be on our current assets.
But remember,
financial position.
So I'm going to say to both of you, remember our limitations, right? Our question said we must do the 3 statements, but only for the convertible bond. So the inventory won't come into this. So be careful of that risk of doing that because you're going to eat up time that you need. Also said, don't do the current and non-current split. So yes, we're going to have the financial liability, but we're not going to split between the current and non-current portion. So be careful of our limitations.
Oh, okay.
Happiness. Okay. Then you have the financial liability, but you also have the equity, right? Equity also goes into statement of financial position. What else? What else? Do we not have any assets that we've spoken about here? The asset that has a whole statement that we just spoke about. There's a whole statement for that one asset. That is classified.
May I ask, what happens to the delivery vehicles? Is it already purchased or we're not allowed to?
Not allowed to?
I'm on the fence on this one. I see all the financial instruments, but the delivery vehicles, is it just there for information's sake or we can do something about it?
So Very good question. I think it depends how the question is worded. But because of how this question is worded, we're not going to do anything about it. Because our part B tells us that we must only on the convertible bonds.
Okay.
So if the question was worded to say, based on the information relating to B, you know, like how here it says refer to note A. If it
Yes.
said refer to note B, then probably would have given us more information about the delivery vehicles. Like, yeah, and then we would bring them on as well. But because we're specifically told only to convertible bonds, we're only speaking about the bonds.
And then number 2, I'm not sure if it passed me, but do we also do we also put in one of our disclosures our credit risk?
Put in our credit risk. So our own credit risk we're going to do the calculation. We'll see now when we get to the fund solution. We'll do the calculation of our own credit risk, and we'll separate that out and present it in OCI.
Okay. Okay.
And yes, there are disclosures as well in IFRS 7 that speak to how to, specific considerations for financial liabilities. So there are specific disclosures on that, but those are not required for this particular question.
Right. No, thank you very much.
Cool. So very, very key exam technique things we just had there, right? Be very, very mindful of what is included and what's excluded. So I think I should have maybe made the only red, so that we know that we are focusing only on convertible bonds. We don't need notes. We don't need current and non-current amounts. Very, very key. We make this mistake so often, and then we end up wasting time, because unfortunately, if you go and you spend time now doing calcs and bring in your inventory and bring in the splits and the currents and non-currents, I will not mark it. We'll just be like, oh, shame. And now you spent time doing that, and now you're eating time that you could have actually earned marks in the tax note. Cool. Yeah, I think we've said a lot on part A and part B. I mean, this is still part B, but now before we move on to the next stuff, speak about the tax note. Are there any questions or additional comments you want to make on the convertible bonds before we move on? Oh, I was still asking a question. We are missing a very key asset, guys. Very key asset. It literally is one of the things we need to speak about.
I'm going to guess. I'm thinking cash and cash equivalents, but the thing is, it's not part of the of the convertible bonds. And then I'm thinking the bonds themselves. This is literally at the top of my head, guys.
No, Sandy, you're right. It is the cash, guys, because the cash is in relation to this bond. We've got cash movements, right? Because of these bonds we've issued, we are receiving cash. So it is related. It is related to the bonds. We've got the cash, which is as I'm saying, an asset that's got its entire statement. So that's the asset we need to bring in. I'm not sure I'm going to write this. Let me just say received. Yeah, received all cash. So then I'll say SOFP. And then there's another cash movement, right? The outflow that you noted. That's also good. So our cash will be affected by what we get and what we're taking out. So that amount will be on the statement of financial position. Cool. I am happy. I'm happy. Are we all happy? Or do you have questions? Cool. Great. Then, this one, I'll start. I'll try. I'll try to go through this in line by line. But I think once we hit off this 2, I want us to actually start going through the solution so you can actually see how this comes to practice, because that's also very, very important. Okay. So this last part is to deal with part C. Part C requires us to prepare specific notes dealing with the current tax expense and the different components thereof. Right? So we are told that the junior accountant was in the process of finalizing this tax expense to include the financial statements, but now shame, he's ill. So the finance manager has reviewed the work and assured you that the amounts in the tax rate recon notes are correct. Radani told us this morning that was not true. There were some directionality issues, but I believe I did fix them before we started this class. So the signs on these 2, I believe, were incorrect. So they asked that we finalize the amounts the junior accountant was supposed to finalize at the office. I've got particular notes there. And attend to the task. Then they give us an extract of the tax recon note, which the junior accountant prepared. Anything worth mentioning there, guys? No? Okay. Comfortable. I think from my side, it's just that we know which note we're finalizing, which is a tax expense, but we're told this in the required. So just worth noting. We know that we've been given the tax recon note, and this is what we're working from. And then we know that everything that says to finalize is what we need to be cognizant of. Cool. Then we've got the tax recon note. So we've got right before tax of 10.5 mil. We have the tax rate applicable, question marks, that's for us to figure out. Dividend income, and then, okay, so we've got a few things, right, essentially. And we've got, what I found different when I looked at this note was that usually people prepare this with actual amounts, right? So it's easier to follow. This time we've chosen to prepare it by, with what you call this, with percentages. So we are going to have to determine the amounts for ourselves. First thing I noted.
Can I ask a question, ma'am? It might be a dumb question.
No such thing, go for it.
The extract in the tax reconciliation note, the profit that the junior accountant has is 10.5. But then at the beginning of the question, we were told that the profit before tax was the 9938400. So now we're sitting with two starting points, and normally when I'm doing the tax, I would normally think, is it correct? Is it accurate? And then after that, you pass the adjustment. So now with getting the 9 and the 10, the starting point becomes a problem, because now I'm going to thumbsuck and I'm racing with time.
Okay. I love that chain of thought. That's exactly what we need to do, right? We need to remember, we need to be applying a critical lens all the time to say, but this now, it's not consistent with what I saw earlier. Why? Then, luckily for us, they've given us a note, and this note tells us that this profit before tax has been correctly adjusted for the error described in A above. So now we know that there is going to be a difference, because remember, at the top here, we noted that this tax is correct except for the error in A. So they've explained to us that actually, moving from this 9.9 to this 10.5, we've made a correction for the error. So this should then be the correct amount to use. Does that make sense, Sandy?
Fantastic. Thank you so much.
Happiness. So that's exactly how you need to be thinking about stuff. Do not just accept whatever has been given to you. Question it. Question it. Cool. Yeah, so as I said, because now we don't have amounts, so we have to calculate it ourselves. Cool. We know specific things that they haven't given us, like assessed loss. So we know there's an assessed loss somewhere. We know they're going to talk about a tax rate change somewhere. And in the notes, break that down. So the first one we discussed with Sandy's question just now, that they're telling us that this profit before tax is different, what I told you earlier, but it's different because we've now adjusted for the error. So we are fine now. We are fine. This one is correct. Don't panic. For note 2, which speaks to assessed loss and the tax rate over there, we are told that the Minister of Finance announced that the tax rate is changing from 28% to 27%. And it's effective commencing on or after 1 April 2023. Again, my lovely timeline. We know 1 April 2023, that's after the start of our current financial year, because our financial year started in 1 February 2023. So it's not effective for this year. So what does that mean? It may not necessarily affect current tax, because current tax is going to be at 28%, but it's going to affect deferred tax, because deferred tax, remember, we use the rate based on the rate we expect to be in use at the time that that it's settled or utilized. So it's going to affect our deferred tax. And remember, when we looked at IS 12, which I'll go back to, there's a specific disclosure in paragraph 80 for the effect of a change in the tax rate. So we know that we've already got something here. Cool. And then the capital gain rate has not changed. Okay, I'm not highlighting, which is terrible. Happy. So when if you guys get the time to do this by yourselves, I strongly suggest starting to practice with the timeline, because at least this timeline is not too full, because there isn't too much going on. For myself, that don't worry about it for this FY. That's next year for us. Cool. Then we're told that during FY 2023, so prior, we generated an assessed loss of 5.7 mil. So the first time that we had an assessed loss, and the 1 January, we didn't see a chance, or it didn't seem probable that it would make a profit, or excuse me, guys, that it would have sufficient taxable income to earn against assessed loss. And taxable temporary difference was correctly calculated as 5.3 in the 1 January last year. Okay, I feel like I haven't paused to ask you guys what you think for a while. So what do you think? What is key in this paragraph?
I think for me, when it comes to assessed losses, the thought process is when you're doing my deferred tax calculation, am I allowed to deduct? There's a limitation. If you're going to make profits, or if you're not going to make profits, you're allowed to, I don't know what paragraph it is, ma'am, but yeah.
That's fine. Don't worry, you don't need paragraph references. It's fine. You're right. You're right. The consideration that they've specifically told us we've got an assessed loss here of 5.7 from last year. And we're also told that at the end of last year, it didn't seem that we'd have enough taxable income to earn against the loss. So what that means is we probably didn't recognize the loss. That's what they're telling us. That because, or we didn't recognize the deferred tax related to assessed loss, because we couldn't, right? Because the standard tells us that we can only recognize it if we've got sufficient, if we see that there's sufficient taxable income in the future, which we're gonna use the assessed loss with. Happiness. All right, and then we know how much of the taxable temporary difference existed last year.
Ma'am, can you please clarify with regards to like assessed losses when you have to recognize them and as well as utilize them? I understand like there's a different way with which we account for it. It just throws me off like a lot of times.
Okay, no problem. So when we've got an assessed loss, an assessed loss, and we're not thinking about whether or not we can recognize it. We're essentially thinking whether or not we have a deferred tax asset in relation to assessed loss. And remember, to recognize a deferred tax asset, there are conditions, one of them being that we believe that there's going to be sufficient taxable income against which we can use the assessed loss. So with deferred tax assets, whether it's from an assessed loss or from temporary differences, the limitation is always that we believe that we will be able to use in the future. So we see profits or taxable income coming in the future. If we don't see those, we can't recognize assessed loss. We'll keep a record of it, so we know how much we have not recognized in the past. Does that make sense from a recognition point of view?
It's from a recognition point of view, it does. Only the utilizing part now.
Cool. So now I'm speaking about utilizing the assessed loss. That is now, you'll see here, now we have this assessed loss of 5.7. We recognize, let's say, the deferred tax asset. And then we have taxable, actually, this assessed loss, what we're going to do to utilize it is we'll do this wonderful calc and determine what our taxable income is. And how we're going to utilize our assessed loss is we're going to decrease our taxable income with that assessed loss. So what the effect will be is that we're going to then pay over less tax in the end. So it's going to decrease the taxable income by which we are going to multiply 28% and pay over tax. So utilization is when it comes out deferred tax asset, reduces our taxable income, and reduces our overall tax burden. Does that make sense?
I'm not sure if I follow, right? So we had an assessed loss of like that amount, the 5.7 million, which was not recognized in the previous year of assessment because we did not have sufficient taxable income that we will use to set up this assessed loss. And then going forward, which is now, did they say, do we have to wait for them saying that there will be future tax losses before we can recognize the deferred tax asset?
So remember, we recognize it once we believe there's future taxable income that we're going to use it against.
Mm,
So when we do our calculation this year, we're going to see what our taxable income number is. You'll see in the solution when we go through it that it's going to be higher than this 5.7 million. So there's clearly now sufficient taxable income to use this 5.7 against. So then we are going to use that 5.7 to reduce the taxable income in this year. So it won't result in a deferred tax asset anymore because it's gone, but it's going to reduce the current taxable income because it is now sufficient to utilize it.
Okay, I think I get it. I think I
Okay.
do.
Let's see. We'll try to do the solution if it lands.
Okay.
Cool. Happiness. Any other questions? Yes, Samantha.
So with assessed losses, so does it mean that like when you have an assessed loss and then you have a deferred tax liability, but at the same time you're saying that we don't think we're gonna make enough profit this year to use the assessed loss. So my understanding is that you would recognize an assessed loss limited to the liability, and then is the effect that they net off, but they're
Exactly.
still separate.
So you've got the deferred tax asset, deferred tax liability, but I guess on a net basis you'd have nothing. So you can't recognize more of a tax asset because you don't think there's anything coming in the future. If, however, you thought there was enough in the future, you probably wouldn't have a deferred tax liability, or you'd have an asset that exceeds the deferred tax liability.
Okay, but then like in your books, there would be you would have an asset, you'd have a liability.
Yes, but there would be, yes, so you have an asset and have a liability, unless, because there's also a specific condition under which you can net off deferred tax assets and liabilities. If you meet those criteria, you'd net them off and probably have nothing on your financials.
Okay.
Yeah, so if you meet the net presentation criteria, you'd have zero. But if you don't, you'd show a deferred tax asset and a deferred tax liability.
Okay, thank you.
Cool. Happy. Cool. Okay, guys, I'm going to just go over this very quickly. Sorry, just so we can jump into the solution before I run out of time. So we've got dividend that we're earning from listed shares, but we have not received at year end. So the thing with deferred tax, always we're thinking about what are the tax consequences, right? Tax versus accounting. We know dividends, it's not part of the income tax. It's got its own withholding tax, so not part of what we're doing here. I mean, it's part of it, but we want to take it out. We then have fines and penalties here, which are from government Department of Energy. SARS doesn't allow us to deduct anything for fines and penalties from government institutions, meaning that's going to come out. So it's going to be reversed when we calculate taxable income. Then we've got trade and other payables. So now we're thinking about back to the stable financial position approach or method. What is the tax base of these particular items? So we'll have the carrying value, tax base, and cool. Can you guys hear me again? Cool, thank you. Okay, so I was saying tax base. So here we've been given the carrying amount. So considerations is, okay, what's the tax base? Typically for financial liability, tax base would be carrying amount, less amount deductible and taxable in the future. So typically it'd be carrying amount. All right, but we'll get in the solution. Then we've got a foreign income from its branch in Kenya. Sorry, I forgot to fix this one. So the other error that Rundani mentioned earlier. So what we know about this foreign income is we're taxed at Kenya at a rate that's different from what we're taxed in South Africa of 28%. But in terms of the DTA with Kenya, this income is exempt from the South African tax system. So again, I'll take it out from our taxable income. And then we've got consideration on bad debts. So here we're going to be thinking from a tax point of view, what do we do with allowances? How much of it is, deductions, which part is written off, all the wonderful stuff, right? What's the tax rate of a prepayment? Cool. Then PPE. We've got PPE that's held during 2024. Here they're going to give us the carrying amounts, of course. We've got the closing balances at year end. Then they're going to tell us what the tax values are. So again, I would always highlight and know how to compare. Then we are told something specific about, so we are told that but given the, no, it's not listening to me. We are given the carrying amount of, what's this one? I think it's the machinery. Yes, machinery and vehicles. And we're given the tax values as well. So I would highlight those that are similar in the same color. Right. So this one is for the buildings. So we are told that the carrying value is 14.5 and the tax is 13.5. But in addition to that, we are told that for the buildings, we're depreciation expense for a warehouse, and SARS does not grant wear and tear on a warehouse. So that's going to affect our tax base. There's something we're going to have to take out when it gets a PPE on the tax base. And the carrying amount of this warehouse at year end was 500,000. And there are no other temporary differences other than this in the scenario. Okay, so part C's got a lot of information, a lot to sort through, a lot to think about. Cool. I'm gonna quickly go into the solution. I think, look, we've discussed a lot of it, especially for A and B as we've gone through it. So I don't expect it to take too long for A and B. We're gonna spend most of our time on C because we didn't go through in as much detail, or much detail at all, to be fair, right? So looking at the solution, what we said is we need journals. So before I carry on, are you guys looking at journals? Are you now looking at a different screen? Are you looking at the solution? You're not looking at the question still. So the question is that my screen change over, or is look at the same screen? Okay, well, good. Thanks, Sandy. Cool. So first, from an exam technique point of view, we said we must have these P&L, SFP, P&L, right? To make sure we're in the right, the right statement. We must have a narrative. I'm just told otherwise. In this case, we don't have dates, but we should generally always have dates. Reason we don't have dates is because everything's happening on the last day. It's actually happening after year end. So yeah, not recommendation, always include to not run the risk of losing your presentation mark. Okay, so we spoke about the error. We said the error was that certain amounts are put into inventory or deducted from inventory. So the problem is that our inventory is too low. The amounts that were deducted from inventory should have actually gone into P&L. Question is, what should it be based on? Should it be based on the inventory that we bought, or should it be based on selling distribution cost? We were told the reimbursement is based on distribution cost. So in the current year, we spent 950 on distribution cost. Multiply that by 20%, and that is what should have gone to either to other income or to reduce the distribution cost. Either way, it should go to P&L. That's at 190. So you're gonna get the mark for the calc here of the 950 times 20, as well as the correct journal. Then we also know, and this was something that we said we weren't sure of what the point was. We also know that of the current year inventory, some of it is still retained, some of it has already been sold, right? So for the portion that's retained, we're going to correct the inventory balance. And the portion that's retained, we said was 40%. Excuse me. So 40% of this 190 needs to be corrected to inventory, and we're correcting inventory by increasing it because it's understated at the moment. So we're in of the 40% of this 190 is going to inventory. Why 40%? That is the amount that we said is still in closing inventory, so that's the amount of inventory that has not been affected by this change yet. 60% of this inventory has actually been sold. Right. So as much as the inventory was incorrect, so it was understated, but that is no longer, it should no longer be a statement of financial position anyway. It should have gone into P&L through cost of sales. So we are correcting the cost of sales amount by with 60% of 190. If I can say that differently, the error was that inventory was incorrect. So 100% of this 190 initially is destroying or making our inventory wrong. So at the correcting entry from the first step would have been to inventory. However, because we're at the end of the year, only 40% of the inventory is still held by us. So only 40% of that is going to be recorded on statement of financial position. So that's why we're only correcting 40% to inventory. Other 60% has been sold. So although it would have been a correction to inventory, that inventory would have been derecognized and that amount would have gone to cost of sales. So that's why our correction here is to cost of sales. Does that make sense? Not promising. Not promising at all. Okay, thank you, Katato. Anyone have a that isn't comfortable can tell me what it is that's not 100% clear.
May I ask? Sorry.
Yes, please.
I'm looking at the journals, right? And to be honest, is that I want to ask that are we writing the original journals that it's supposed to be, or are we correcting it?
We are correcting it.
Oh.
We are correcting it, and that's why the correction is looking at where are we at year end. We're looking at the fact that 40% is still in inventory and 60% isn't anymore. So that's
Sorry for taking you a little bit back. I know we're on time, but I'm stuck because the way I understood it is that we are okay. So you said we're correcting it now, right? So now, as we look at the journals for correction's sake, first of all, I'll say, oh yeah, I need to get 20% of the reimbursement. So now we are going to get it from which part? Is it the 19 million, the 16 million? Wait, I'm looking at the journals and I'm looking at the scenarios. I'm a little bit confused.
Let me go back to the scenario. Okay. So, I understand your question because that's we actually had we had a very similar discussion, but look, okay, so we're coming with the 20%, right? Because we're told that electronics will reimburse 20%, right?
Okay.
The question is 20% of what? And then the answer is they're reimbursing 20% of our selling and distribution costs.
20% of our selling and distribution cost. Okay.
Then in this paragraph here, we are being given amounts. So we know 16 million is purchase of components, that's inventory. So 16 and 10 is inventory. But we are told selling distribution is 950 and 700. So 950 this year, 700 last year. So starting point is what should have been our rebate or other income should have been 20% of 950. So that's of 950. So that's line. Where's my solution?
So that's the first thing. Now I'm writing a test or an exam. That's the first thing I'm triggering right now. It's that 109. That amount, sorry.
190,000.
Yes, 190,000.
First thing, you know that what should have gone to other income or to reverse log selling distribution cost is 950 times 20%, so that 190,000.
So the reason why we're reversing it because the first time we expensed it, right?
We didn't expense it. What they did was they reduced inventory.
Okay.
So they took a credit to inventory. So our inventory is lower than it should have been because they thought like a kind of a rebate or a discount or something. So they reduced our inventory balance with it.
Oh, all right. Now I see it.
Okay. So, and I think I understand your question, right? You're feeling like, okay, we're correcting, but we're showing what should be because this line is showing what should be. We're saying here,
Yes.
this is right. It should be 190. That's what we're doing, right? You didn't do it. You didn't do it. You didn't put anything to 190. This is where we are.
Okay, sorry. So what, okay, what initially happened, if I look at their journals and their errors, right? They took that amount and they said, you know what, this amount is an expense and we're decreasing our inventory. So if I feel a little bit dumb right now.
No, don't worry. I wanna try to open Excel so we can go through the journals. I also like sometimes accounting is just better when you're actually writing it down. Otherwise, it just doesn't make any sense. But now I
So
don't know what Excel is.
yeah, I think Excel will work because I wanted to find out if initially this is how they recognized it and this is how we're supposed to recognize it and this is the difference. I think I would have my
That'll
thought
help.
process. Okay, yes, please.
Let me use the Excel we've got here for something else. Okay. Trust everything to fight me.
Yeah.
Okay. So what they would have done is electronics. Sorry guys, I can't stand grid lines. So electronics would have given us cash, right?
Yes.
So the debit would have gone to bank of 190,000. Right? Then they would have said, this is actually a discount or rebate to inventory. So they would have, sorry, I'm not gonna do the SFPs like I'm teaching you to do. Actually, let me do them. Otherwise, I am doing the wrong thing. Okay. So they would have then credited inventory instead of P&L. They would have said this actually is a decrease to inventory of 190,000. And our problem here is what? Now our inventory is too low because this is actually, it has nothing to do with our cost of inventory. Our inventory is too low. And our selling and distribution costs have not been reduced as even though we've received money to reduce them. Right? So this is what they would have done. Guys, ACC. Okay. Forget that. This is what they would have done. What they should have done was definitely debit to bank because we did receive cash. But the credit should have been to either other income or selling and distribution costs.
Okay.
Right? So that's this leg of theirs should have been here. Cool.
Yes.
So what we have is the mistake is our inventory. This creates the inventory, and this. So this was done that was wrong, and this wasn't done. That's what we're missing. So to correct this, we're happy. Bank is obviously right. We have money. We're not doing anything to bank. We have money. We're not giving it back. We are very, very comfortable.
Yeah. So now what were happening is that now, okay, fine. Now I'm at my exam room. It's like, okay, cool. I see my inventory is at the wrong place according to what they did. So I am now debiting it back, but according to the formula they've given, the policy they've given.
Okay. So when you say the formula, talking about that 60-40, eh?
Yes.
Okay. So I did say this could be confusing. Okay. So that is, yes, that's the right way, but it's a shortcut.
Oh.
The other alternative that we could have done is we could have just simply said, and I think this would be clear for you guys. It's very clear what's happening then. We could have just done the two legs that are wrong, right? Just do this. Sorry, guys, I am not doing the right things. So we could have then said, okay, we identified that what was wrong was this credit to inventory that happened, that shouldn't have happened, so we're debiting inventory. Well, we're increasing inventory. We should have gone something to P&L. Let's take it to P&L. So we could have just done that. Right? So that could have been step one. That's a step one. But because now, where we are at year end, part of this inventory is no longer inventory. Because remember the 950 They would have taken it against the whole inventory balance, but part of this inventory balance now, first in, first out stuff, part of this inventory balance is actually no longer in inventory. We are assuming that they would have reversed it to the 16 million worth of inventory we bought. 60% of that inventory has now gone through the income statement because we've sold it. So then the second entry, what a typical entry that happens when we sell inventory, we debit cost of sales. And we credit inventory. Credit inventory by how much? By the 60%. Because I get we've got 40% left over. So we then say the 190 times 0.6. That's our cost of sales amount. And what's left over in inventory would be my numbers do not look right. Oh, so I said a plus. Okay, so that's our remaining inventory balance. Okay, so let's go back to here. That's exactly the amount here. So that's it. What you've done is just a shortcut. You could have had an alternative of doing. Where's my? Sorry, guys. You could have done two journals. We just combined them. So we took these two journals together and said the net effect is that we would have taken an amount to the other income, P&L. We would have taken an amount to cost of sales for the 60% of the inventory has been sold. And what would be the correction that was left at inventory would have been 76,000. So that's why our solution is actually a collapsed portion of what I've just done over there. Does that make sense?
Yes, it does. Thank you very much.
Cool. Everybody else happy? Anything you want me to clarify? Cool. Happiness. Okay, then now remember we were told to bring in the deferred tax as well. So now our inventory was too little, right? The balance we had sitting at year end was short of 76,000, meaning our deferred tax liability was short for this portion. So what we're doing is we're increasing our deferred tax by the 76,000 times 28%. So it's this amount going to deferred tax and deferred tax rates into current year adjustment. That's what that journal is. Obviously, the contra for deferred tax will be the income tax P&L line. Comfortable? Something, guys. Thumbs up, question, something. There we go. Sandy, go for it.
Sorry, I just wanted to say I'm following. Sorry, I clicked the wrong thing.
No problem. Okay. Then this one is similar. This is even more condensed. So if we thought this one was condensed, this is even more condensed. It's the same kind of condensed, but it's more, right? Because now we're looking at last year. We're saying, okay, we didn't really make this mistake for the 950, which is to 2024. We made the same mistake for the 700 for 2023. So that affects our opening balance of inventory, right? But same argument. So we could also do the alternative of doing first inventory and then cost of sales. But in this case, because of the first in, first out method, we know that all the inventory that was in the opening balance at the beginning of the year has now been sold. So again, our shortcut journal is we're going straight to cost of sales. We're taking error straight to cost of sales. Oh, the correction of the error to cost of sales. So taking the 700,000 times 20%, taken to cost of sales, because the full 100% has been sold now. So 25% was the opening balance from last year. It's all come through P&L. And the difference, okay, then yeah, this is a very, very condensed journal. So we had now, let me think about this. we had this amount in inventory, or we had made inventory too little. So we would have reversed inventory, taken cost of sales, and then we would have had the deferred tax on that inventory, similar to the journal we've got up here. So on the 700, on the 20% of the 700, yeah, on the 35,000, we would have had deferred tax. So this journal here. So this is a very condensed journal. It's like these two in one. We would have had this 28%, and that's the deferred tax there. And then we would have also had an amount that should have gone to P&L last year. So this other income line. But obviously for lesser tax goes to retained income, because now we're looking at last year's P&L. So very condensed. It's literally these two plus that inventory one that I did, all put into one journal. I think maybe what I'll do is after this class, I'll do the different steps. So, and then we'll send you the Excel with the different steps and the alternatives, so that it's easy to follow. Cool. And then, because now obviously this was the initial deferred tax entry, to correct the different deferred tax to bring up the opening inventory. Inventory's been sold, so now I have to take that deferred tax out. Right? So what we'll do as well, once we sell this remaining inventory here, there's no longer deferred tax. You no longer have a deferred tax asset related to liability related to it. So you debit the deferred tax, and the contra is the income tax. I think for these journals, they look very cute and simple right now. I think what I need to do is break it into an Excel and explain the step by step, and then we'll send that to you guys to make it easy to follow. Are we happy with that? Cool. Thanks, guys. Cool. And so that's how we'd earn essentially all these marks. Very key. Don't forget the statements. Don't forget to show your calculations, because if you just give me amounts, I don't know how. And especially if you make a mistake, I won't be able to give you marks for doing the right percentages. Excuse me. So don't forget all of that, and you can do either alternative. You can do this alternative or the condensed version, or you can do what I'm going to send you in Excel, which is a step-by-step approach. Cool. Number two, I think this is another convertible bonds. We pretty much discussed all of this, right? But I'll go through it, but we discussed all of it when we're looking at the information. We spoke about setting up the statements. So first of all, can't lose the presentation marks for setting up the statements. It also helps to direct your thinking and focus your calculations. So first, they've done the statement of P&L. They did not write it. We did not write it. We should have. We should have had a heading here to say statement of profit and loss and other comprehensive income. Then we know we need interest income, like we spoke about. Let's actually just go back to what we said we're going to need. Right. So when we spoke about, I was going to go to P&L. We said we're going to have fair value gain or loss, and we're going to have an interest expense, and we have OCI for own credit risk. So when we go to our solution, what do we have? We bring those lines on. We bring interest income, we bring fair value adjustment on convertible bonds. Then, very key, don't forget other comprehensive income is a separate section. So you do other comprehensive income. Then also, don't forget the sub-classification. That changes the own credit risk amounts that will not be reclassified to P&L. So don't forget to include that heading, because it's very important for you to know that, right? Remember OCI, there's certain amounts that can be reclassified and others that will not be. And it's a requirement of IS1 that when you're in other comprehensive income, you list them separately. So very key to bring those in, amounts that will not be reclassified to P&L, and adjustment for own credit risk. That's the line. Cool. Those are all the amounts we expected. Happiness. Then we've got a statement of financial position. We spoke about the assets. Again, we can go back quickly. SOFP, we said we've got, we've got cash, financial liability, equity. We didn't actually speak about the part that's going to go into equity, but it's fine, we'll see it now, right? So we've got the asset, the bank. We've got the equity component of convertible bonds. We've got the own credit reserve, so it's basically the own credit risk that you spoke about in OCI. And we've got retained earnings. That's the one thing we forgot about, right? We mentioned liabilities, so we're going to have the bond, the liability to bondholders. So we've got all these notes, all residues put in the structure. Statement of cash flows. So in our solution, we've got under financing activities, but you do see, we did note that it could be an operating cash flow because interest can be either or. So you wouldn't be wrong if you had operating activities and had cash outflow to bondholders or interest payments or whatever, and had this 450,000, we would mark that right. Under financing activities, though, the inflow on the bond issue would have to be under financing activities. Cool. So here, no real calculation. This comes straight from the question. So this you can literally do and be done with instantly. The others, it was more putting in the structure and making sure we've got the right amounts. And then now we go into the actual calcs. We spoke about the method. We know what the total is, which is the 10,000 times 1,000 coupon bonds. So we've got 10 million there. We are doing the PV calc, which we spoke about, to figure out the liability component. So we know we've got 0 future value, got a coupon payment of 9% twice a year. So that is 450. We've got a rate. So the rate comes from the table they gave us here to speak about the market participants or market rates will be, but it's the rate at 31 July. See why my timeline becomes very important, because you must keep track of which rates are important when. So 31 July, we use at 6.8, but again, it's biannual. So it's divided by 2. So that's the rate we're using there. The number of periods, so we're going to make payments twice a year until 2028, so that's 5 years. So that's 10 payments. Put all these wonderful numbers into your financial calculator, and this is the present value. Sorry, I'll change the dates. These dates are outdated. Okay. And that's your liability component. And we said equity would be the 10 mil minus liability component, and they've got the equity component of 6.2. So just by doing this, we can fill in the rest of our, or part of our statement of financial position. We bring that back. Equity component 6.2. Right? I won't put in the liability as yet because the liability we've just calculated is the liability at 31 July. There are going to be movements because obviously there's payments, there's a fair value, there's the interest, all that wonderful stuff between 31 July and 31 January. So I won't put that in just yet. I mean, you could probably put it in brackets if you don't want to forget. Put it in brackets here and do the calculation on the statement of financial position if you wanted to, but we did not do the calculation there. We've done it just under. Right? So we said, okay, so what's our, now I want to calculate the carrying amount of the liability at the respective dates. So we were given rates at 31 July, and that's 7.32. But we were told 0.42 of that relates to our own credit risk. So that's the portion. So the fair value is different if we include our credit risk and if we exclude our credit risk. And that's the calculation we're going to do here. We're going to go and say, okay, the payments are still the same. We will now have 9 periods remaining after 31 January, right? Because we'll have made the first payment. But we're going to use different rates. We're going to use a rate for just pure fair value without our own credit risk being taken into account. So we'll take the 7.32, the market rate that doesn't consider us, divided by 2, 3.66. Then we're going to take the market rate. Sorry. So this is the 7.32 includes our credit risk, right? The 7.32 is the actual rate. That was 0.42 has to be stripped out of the 7.32. And that's how we end up with the fair value without our own credit risk. Similar, put both things in the financial calculator, come with 2 fair values. Yes, Samantha.
I wanted to ask, when they ask you to like drop a statement, are you allowed to have calculations in there?
On the actual statement.
Yes.
Yeah, you can. Like if it's whatever's easier for you. So like you'll see like here, our retained earnings, we've got a calculation right next to the amount. So for the easy calculations, I would suggest doing them here. It's easier. Like we know the movements in bank, we know the movements in retained earnings. It's just for these, like the actual way you need to do PV calcs and that becomes messy. So you can have them in there. Nobody's gonna punish you for them. It just might become harder for the markers to find your work if it becomes too messy. So it's easier to then do the calcs afterwards and then bring it up. But nobody's gonna punish you for putting it there.
Okay. Thank you.
Cool. Okay, so we know that this fair value is the actual fair value, right? Because this is the fair value to use the 7.32 rate, right? This amount to use the 7.32 rate, so that's the correct fair value. That's what we're going to show on our statement of financial position. But we need to calculate the difference between the two because one of them is if we don't consider our own credit risk. We know that this liability is lower because it's taken into account our own credit risk. Our own credit risk has increased the rate we're using and resulted in a lower liability for us. So that's a credit. That's actually a credit, which doesn't make sense. So we need to work out the difference between those two, and that's the amount that we want to take to OCI. Cool. So here we've calculated the fair value of the liability. We can take this amount and put it on the liability here. Like I said, remember to always number your calcs. Yeah? Cool. Then the next calculation, we are starting from the beginning. We are saying at 31 July, this was the 3.7 we calculated on day one for the first PV calc. We've made a payment in January of 450,000. Then we calculate what's the interest expense. I know we're doing a fair value, but because it's this kind of instrument, we should calculate the interest expense on it. So we're going to take the opening of 3.7, multiply it by the rate we had before we changed, so 6.88 divided by 2, right? Or use your calculator because you already did the PV calc, so you can just calculate for the first period of interest, which will then come to this. Then have a difference of, okay, so what is actually my fair value without the credit risk? The difference between those two is the actual fair value gain. So the difference between 3.7 less the payment plus the interest, that difference between and this will be the actual fair value gain. I'll send you an Excel on that as well. Then the fair value gain that goes to P&L. Then the difference between the 3.4, which is the amount excluding our credit risk, and the fair value including our credit risk at 33, that is going onto OCI. So that's the answer for two places. The OCI there, we've got our interest income over there, our fair value over there, we've got our OCI under equity as well, and our retained earnings under equity. So yeah, I think we've done the full statement of financial position. Yep. And the statement of cash as we did initially, right? Because there was no calculation there. We had the cash inflow. So we did the 1,000 rand times 10,000 bonds, 10 million. Then we did the interest payment or the coupon payment, 450. We already have that. So part B, we are done. Comfortable? Any questions?
Can you please go back to the fair value calculation? I want to see something. The interest,
this one.
Yes. I wanted to see the interest. Which one? The fair value.
Should I go back to this so we can see?
No, the calculation, because I want to see the interest you used for the fair value adjustment. Is it without credit risk? Oh,
So I did both. I
yeah,
did.
on the lower table, can you please go up?
Oh, this one.
Yes,
this one.
yeah.
So this one, remember, this was the rate at 31 July 2023. So the day we bought them. Sorry, the day we issued the bonds. So between 31 July 2023 and 31 January 2023, nothing had changed. The 7.32, which was the one we used for the fair value calcs, was the
Yeah.
change we got in 31 January. So for the interest, we're still using the original 6.88 divided by.
Okay. Oh, that makes sense now.
Okay.
Thank you.
Happy. Cool. Any other questions? Okay. Cool. Yeah, I think we did discuss this quite a bit when we were just discussing the classification stuff. Are we comfortable with the own trade risk stuff? And how we did this calculation and got this difference here. Cool. Thanks, Katato. Bernice?
I'm not comfortable. I was waiting for this part, to be honest.
Okay. Okay, cool. Let me try to show it because I also did a different Excel calc. It's just that my Excel seems to be too cool for me today. And I don't know if the calc I'm going to try to show you is even more confusing. I hope not. Hope it actually clarifies.
I believe in you. I know that.
Thank you, Bernice. Thank you. On sheet 2. Okay, now I did the journals. Okay. So, again, trying to do it step by step. We've got the opening balance, which we calculated on day 1, the 3.7 mil. That's the amount that we use to determine the equity as well. Comfortable. Then, on 31 January, we're making a payment of 450,000. So, our balance, before taking into account any interest or fair value or whatever, would be this 3.3 mil. But we also know that there was, okay, this is going to confuse you. We also know that we actually already calculated the fair value. So we know for sure that the fair value is 3.398, right? Because we already determined this, we know what the fair value is. The difference between the 3.3 and that 3.398 is 94,000. Okay, but remember now the fair value movement. Before we even get there, we haven't done interest yet, right? So our interest is, let me just remember the rates for myself quickly. It's 3.4. What is it? 344. Okay, so would be this 3.7 million times 0.0344. Right, and then okay. Okay, so what did I say? I said, okay, I said our interest is this 1.29. Let me maybe bring it higher up, and that will maybe make it even better. Okay. Okay, comfortable. That's our interest over there. Then okay, that's the difference I've got over there. Comfortable. What did I want to say? Oh, okay. We've got the interest over there. But to get down to the oh yes. So to figure out our OCI, right? Reported risk, our own credit risk. We could have simply done a calc completely separately, right? So to see the OCI portion, we say what was the fair value with credit risk, and then that was that was this 3398. So that's the fair value we're going to show on the statement of financial position because that is the actual fair value. Then we say what's the fair value without, right? And that's this other amount determined here. Going to the table here. So this 3431363. Got it here somewhere. Right. Then the amount that's supposed to go to OCI, so our own credit risk, is essentially the difference between these two. Because what our credit risk has done, or the effect of our own credit risk, is that our liability is lower than it should be. Because now we're using a higher rate than we would be if we didn't have our own credit risk featured in there. So we are stripping out this 33. This 33, the difference between fair value with credit risk and fair value without, that's the amount that's going to OCI. So you bring that here. Sorry, my laptop is now moving very slowly. And then that difference between my signage is showing me flames. I hope that's right. That should be the amount that's the fair value in P&L. Okay, so let me try step by step because I think it was confusing because I did it with you guys on. Okay, so first of all, the portion goes to OCI. That was actually the portion that we could calculate even without doing all of this because we had done the two fair value calcs initially, right? So because we'd done these two calcs to determine what is the fair value, that includes our credit risk, so using the 7.32 that takes into account our credit risk, and what's the fair value once we take out our own credit risk, we already know what the difference between, we can already calculate what the difference between the two fair values is, and that difference is in relation to the only thing that's changed, the only factor, the only input that is different is that we've taken out our own credit risk in this one. So the difference between these two is the amount that must go to OCI. So that we worked out. That's what this calculation was doing. It's determining, determining the amount that must go to OCI. That's the whole point of this portion, right? Then, because we already have this portion, we have pretty much every input we need. We've got opening balance we calculated earlier. We calculate the interest because we've got 3.7. We know what rate to use, so we calculate the interest. We calculate the payment. I mean, we know what the payment is, so we deduct the payment. Liability, opening balance, plus interest, less payment. If we went to measure at fair value, this would probably be what our liability balance would be. Right? This would be the liability balance. But because I'm measuring at fair value, we know it's at this 3398, which is that amount over there. The difference between those two is the fair value. It's the fair value difference. That fair value difference, though, we know consists of a P&L portion and OCI portion. And because lucky for us, we already know what the OCI portion is. We just simply deduct that OCI portion from this, and that gives our P&L portion. Did that help at all?
Yes, there is light.
There's light. Yay!
Yes.
There's light, guys.
There's light.
Okay. Okay. Cool. Wow. I am so far behind time, guys. I'm so sorry. I am so sorry. Yeah, but I think we've covered part B now. Is anybody still uncomfortable with any part of it? Because if you are uncomfortable, please do voice it out. You can write it in the chat as well, and then I can consider if there's another, I don't know, further breakdown I could do in Excel and then ask the team to send it to you guys. So please let me know in the chat if there's another portion that you'd like me to unpack. Okay. I did not delete my comments. Okay, I can just not show comments. Cool. So, like we did with the part B with the presentation, right? Always do your structure. Always know what you're trying to do, and that will inform the calculations you perform. So I think when we started, I went to, I'm just out of the status now, but I went to IS 12 because they told us this question was very specific. That we must only disclose what's required. Okay, can you guys hear me again? Thanks, guys. Okay, so 79 wants the major components of the tax expense or income. And 80 tells us it's current tax, any adjustments, deferred tax, for origination and reverse of temp differences, deferred tax for change in tax rate, tax losses, unrecognized tax losses. So we can already, we've already gone through the question, so we know which things are relevant here. We know we've definitely got, almost got temporary differences. We know the change in tax rate. We know we've got unrecognized tax loss. We know we've got a, we know we've got the benefit, right, of the unrecognized tax loss. We know we've got an unrecognized tax loss. We don't have write down reverse of deferred tax asset. Yeah. And we already corrected for our error. So we're good. So what we do is we set up our structure to take those items into account. Actually on this one. Okay. So we set up our structure to take into account the current tax, which consists of normal tax, foreign tax, deferred tax from movement and temporary differences, tax losses, rate change, But this, for the most part, needs to be calculated. So then we go further and calculate them. The one that's easy to calculate, and I think this answers an earlier question to say, can you do the calc in the notes of the statement? The foreign tax was relatively easy to calculate because they told us the income was 1.8. What we're saying is it's exempt. So what we're doing is we're saying, look, this income was in our accounting profit, but this income needs to be taken out for taxable income because we're not going to be taxed on it from a South African point of view. We're already taxed in the foreign country. So we take the amount, the 1.8 times 28%, right, which is our tax rate, minus the effect it has on our tax rate recon. So this is how we actually use our tax rate recon here. Because remember they gave us this nice recon and then told us the effect of each thing. So it's also going to be 0.84%. This foreign tax adjustment is 0.84% of the adjustment. Or adjust the tax by 0.84. So what we're doing in this calc is I'm saying 1.8 times tax rate minus 10.5 times 0.84%. That's the amount that we're taking. That's the amount that the foreign tax has on us. Right? So we'd get the marks here for the calc of the 1.8 times 28% to realize what amount it would be taxed at if it was included, but then taking it out because we know that it has an amount of an effect of 0.84% times the profit before tax. Cool. All of these we're going to discover or calculate at the bottom here. I think it's easier to start with current tax. So we start with the profit before tax for the 10.5. Also the earlier question, always we should using the right profit before tax. This time we know it's 10.5 because the note told us that this was after the correction of the error. So we know that we start with 10.5. Then what we're doing here is we're correcting for the effect of, what am I saying? We're correcting for the effect of amounts that aren't going to affect current tax for the year. So for instance, the dividend income, we said earlier, it's not part of income tax. It's got its own withholding tax of 20%. We're taking it out. So we're going to, it's going to be a negative. So we say profit of 10.5 times 0.95 divided by 28%. So all these percentages that I'm going to see here, they all come from here. They all come from a tax rate note, tax rate recon note, because the purpose of tax rate recon is to show what effect each line, each adjustment has on our overall tax rate, right? So we're going to say our tax rate is, let's say, our tax rate is 28%, and each of these has a 0.95%. This one has a 0.95% effect on the 28%. So that's why our calc looks the way it does here. 0.95 divided by 28. The next one, they said it has a 0.14%, divide that by 28. And that's how we go through all of them, right? Fines and penalties, we're taking those out because we don't get deduction from a tax point of view for this. So we take it out, but because it was an expense for us, it is an expense for us, to take it out means to add it in, add it on this recon. Similarly, it's written off, need to be added back. Of the warehouse, that's the item that they said SARS does not give us a deduction for. Again, whatever an expense needs to be added back. The foreign income I spoke about earlier, it would have been an income, so we need to take it out. Movement and temporary difference, that actually comes from the top here. You'll see when we get to this calculation over here. And then that brings us to our taxable income. So, if this works, there we go. If we then start with our profit before tax, deduct what we need to deduct, add what we need to add, we get to our taxable income of 8 million. This then answers the earlier question about, so now what about this assessed loss? So now this 5.7 million assessed loss we brought forward is now being utilized. And what now happens is that it decreases our taxable income, and we now have a taxable income of 2.3 mil, meaning our current tax at 28% is a 663. So had we not had this assessed loss to bring forward, we would have calculated our current tax at this 8 million. But because we could bring this forward, we could utilize our assessed loss to decrease our taxable income, our current tax is only on the 2.3. So 663 we bring to the top. That's our SA normal tax. So far in our schedule, we've got two amounts. We're doing well. Then for deferred tax. So this is now where we do the, what do I want to call it? The statement of financial position method, where we compare the carrying value to the tax base. Difference would be a temporary difference. And then overall temporary differences that we're going to use then to calculate or to determine the movement in temporary difference, which goes down here. Cool. Cool. Okay. So for inventory, we had the components, which was, so this was what I was saying was important for the FIFO method. Because we bought, last year we bought 10 million of inventory. At the end of the year, we had 25% left over. So we had 2.5 million of the components left over. That was our opening balance for this year. So a typical mistake that could have been made when I calculating what the balance of inventory is you could have taken the 2.5, added it as the opening balance, right? Then you add 16 million. Actually have it here somewhere. This is the mistake. You take the opening balance of the 2.5, you purchase 16 million, and then you say your closing is this, you're saying the closing is a 2.5 plus 60 million times 40%, which is not true. Can't be true because you start with the 2.5 million, but that's fully utilized before you started using the 16 million. So all you have left over is what they told you is left over, because you utilized 60% of the 16 million, all you have left over is the 40% of the 16, is the 6.5. So this is, okay, let me do that. That's the right calc. And that's the wrong calc. Cool. So just along that standard FIFO, you fully utilize the initial inventory before you utilize the new. So when they say you've used up this much of the new, that means the other one's completely gone. Okay, don't want to sit there for too long. So that's a 6.4. And we're told in the question that the tax base is equal to the carrying value. So we know there's no temporary difference there. Dividend receivable, you could have also just said exempt. Nothing to worry about there. All right, we got dividend receivable, tax base and carrying amount are equal. It's actually exempt. That's the answer out of you. So just say, look, this is exempt. Excuse me. Trade payables, we know the tax base. Okay, so first of all, easy thing to fill in would have easily been to fill in all the items that we've noted. And this is where I said a bit of integration comes in here. Because this inventory comes from earlier on in the question, right? It comes from part A. So you put in your inventory here. So all the assets and liabilities, pour them in here that you've got the carrying values for and the tax basis for. Put in all the carrying values, then start to think, what is my tax base? This one is equal to this one, I was told. This is exempt, I know this. Trade payables is a financial liability. Tax base is equal to carrying amount less amount deductible in the future. Clearly no amount is deductible or taxable in the future. So equal to the same. Fines and penalties, same concept. Accrued rental, same concept as trade payables. Income received in advance. The amount is still deductible in the future. So the tax base is 0. And you've got a temporary difference of 805,000 there. Payment tax base is, because it's an asset, tax base is amount deductible in the future. I think from a tax point of view, you would have been taxed on this. I don't know. I think at the earlier of receipt or accrual or payment or accrual. I speak at a correction from a tax point of view, but the tax base of this is 0, temporary difference of 60. This is a whole wonderful calculation. Sorry, guys, I'm rushing this a bit now. And now I'm out of time. So trade receivables were given, well, we're given the table here. We were given the table somewhere. Okay. So we know the net receivables is 8.790, but what's included there's a prepayment. So let's take the prepayment out because it's got its own line. So our carrying amount is 8790 minus B23, which is the prepayment. Then our tax base is now 19424 is the gross receivables minus again B23. We're taking out the prepayment, and then remember we get an allowance from SARS for 25% of our ECL allowance. So we're taking out the B23, and then we're taking out the allowance times the amount that's deductible from SARS. Oopsie. The 634 comes from here as well. That's our allowance for credit losses. Right, and then you've got a temporary difference there. Machinery, easier was given to us, right? They told us, again, a different table. Not too far. Let me correct those amounts. But anyway, they told us the amount for machinery and the carrying value tax base, similar than they did for buildings. So we go there. Sorry guys, these should all be 2s. Cool. So that was the machinery. Buildings, remember there was 2 components to it. There was a part of the carrying value which does not get deduction from a tax basis. So we take that out separately. Tax base was just from the future, which is 0. But if amounts are never going to be deductible, it's permanent difference, so it does not have a deferred tax effect. Right? Then you've got 14.5 minus the 500. That's the remaining carrying value. The tax value that we can deduct is at 13.2 million. And you've got the difference of 750. Then we now, based on that, calculate our taxable temporary differences at the end of this year. So it's just all these calcs we've done here. We compare that to the taxable temporary difference at 1 February 2023. Where do we get that? That is when they were discussing our assessed losses and stuff. Just need to find it. Yeah. Sorry, guys. Yeah. The taxable temporary difference on 31 January 2023 was 5.350. So that's the amount that we bring in here. So our opening is 5350. Our closing we've calculated based on using the statement of financial position method. And then our movement of temporary difference is 669, which informs this, which ultimately informs all of this. The rate change, I think we did the calc here. D29. Okay, so once we've done this wonderful calc of the movement of the temporary difference and figuring out what our taxable temporary difference is for this year, we then calculate the 1% change, the 1% rate change on that. And that's the effect of the rate change over there. And then our utilization again of this, of the assessed loss is 5.57. So okay, now let me clarify this. So this amount, the assessed loss, this is not the tax number. This is the actual what would be the, I don't know, asset number at 5.7 million. This here, what we're saying, this amount we're showing here is that 5.7 times the tax rate. That comes as a 1.596 here. And that's the total of our tax expense note. Guys, I know this, I rushed so much the deferred tax. So I know there are probably some areas that are not too well explained. I apologize. I don't know if you even know what questions you want to ask, or if I rushed through that a bit too much. No? Okay.
No questions, ma'am.
Okay. Thank you, guys. Sorry for going over time, and especially because we hadn't our initial communication was not to even get to 3:30. I am so sorry. We will send you the solution if you don't have it, and we'll send you the Excels with the more step-by-step calculations as well. But thank you so much all for your time. I'm hoping to engage with you a lot throughout this year.
Thank you, Kanye, so much. Thank you.
Thank you, Kanye. Thank you.
Thank you very much.
All welcome. Thank you.
Thank you.
Bye.
Everyone. Bye.
Bye.